That is the longest recession projected by the bank in post-World War II history in the UK. Are they going to upgrade from that position? Yes. I think they will still, trying to sort of look into my crystal ball of what the Monetary Policy Committee will come up with, they'll still see a recession, but much shorter and probably much shallower. Why? Because they conditioned their forecast back in November on a gas price twice the level of the gas price, the forward curve today. That makes all the marginal pricing in wholesale markets for UK energy, feeds through to real income squeezes. Yes, we can avoid the recession, but look, events 2,000 miles to the east in Ukraine will dictate whether that curve continues and whether we may be back having this conversation at the start of May when the bank update again, and the curve has moved again. So it'll be a moving feast. Investors need to stay ahead of that.
Well, let's talk about bank rate just around the corner, across the road over at Threadneedle Street.
Yeah.
Back at the end of last year, when things were going a little bit crazy, September, October time, market pricing for Bank of England rates got to about 6%, a six handle. Governor Bailey pushed back against that. We're now at about 4.5.
Yeah.
Governor Bailey is not pushing back against that. Now, do I take that as an endorsement or just Governor Bailey not talking about interest rates?
It's an endorsement. Not an explicit endorsement, but an implicit endorsement. The Bank of England were pretty open, weren't they, back in November? They didn't agree with the conditional curve that they put into their inflation forecast. That, they will say, is why they can have some credibility going back to the market in February, saying, look, a different market path now, one we're more happy with, therefore a more realistic growth forecast. My challenge, I put this in my notes to investors at the time, is I said, look, it's all very well conditioning on the market path, but if you don't believe it, the debate over whether we should actually be conditioning on a dot plot based on what the MPC believe, as the Fed do, is probably a conversation we should have again, particularly if it frames expectations. Investment decisions, both in terms of capex, corporate incentives to borrow, they're framed by what the Bank of England say. Whether they should or not is perhaps a second-order question, but they are, and therefore going back to the market in February with a more realistic assessment of where the economy is going and where bank rates are going is a welcome thing. Maybe the damage, though, has already been done.
You mentioned a dot plot over at the Federal Reserve, so let's discuss that. There is a spread between what they're projecting and what this market thinks is going to happen.
Yes.
Where are you on that side of the debate right now?
I'm with the Fed. They're the ones who make the decision.
You think they get through 5?
Yeah, I do.
What's going to take it there? Inflation being too sticky?
Core inflation. So I look most relevantly, I think, at the elements of the core inflation picture, both wages and rents, that I think are going to remain pretty stubborn. The part, actually, of the dot plot that I think is worthy of far more debate, I'm not telling you where to take this interview, but I think the long-term assessment of where the terminal rate, the R-star is for the US economy, is painfully too low at 2.5%. The real market move here is when the Fed, throughout the course of this year, start to ramp that up. It's always been a bit of a moving feast going with what the market can absorb, but that's where the big move comes rather than the front end where it sees the pathway over the next few meetings.
I'm super happy to go there, so let's go there. Deutsche Bank is projecting, once we do peak, we'll get 200 basis points worth of cuts, maybe through 2024. That long-term dot, where do you see it coming up to? Where does it belong?
Probably 100 basis points higher than where we are at the moment. Yes, you could argue I'm sort of hedging my bet sitting in the middle. But look, 2.5% in a world with very little of the disruptive forces pricing power that has now been introduced in large parts of the corporate sector, the real move, the legacy of the pandemic to shorten supply chains, resilience, security, that would all suggest structural forces moving up the long-term R-star rate, not just in the United States, but actually, and I think we spoke, didn't we, on the show last week about what that's doing to the equilibrium interest rate in the Eurozone. These are pan-continental forces that are pushing up the neutral rate. 100 basis points is probably about where I think the Fed will end with their long-term assessment by the end of the year, but they've got to go on that journey by feeding it to the market.
Regime change.
Yeah.
When you have this conversation with clients, is that a view that's appreciated or a view that gets pushed back on?
Healthy skepticism.
Still?
Yes, of course. I think everyone can understand the qualitative narrative around a higher R-star.
Yeah.
But you've got to start to see that. And there's been some healthy debate, I think there was in Davos last week, about whether deglobalization is actually happening or whether it's something that is easy to talk about. But actually, when you start to delve into the data, actually, supply chains aren't shortening quite as much as perhaps the narrative suggests. Healthy skepticism, this is why, the danger of myself sounding like a central banker, you need to be data dependent. You need to see whether these dynamics actually play out, not just on the basis of sell-side research and the notes that we pump out, but actually actually in the real economy.
Can I squeeze this one in?
Yeah.
I've asked this question twice already this week, so this is 3. I'm 2 for 2. Let's see if we make it 3 for 3. The ECB versus the Federal Reserve. Who hikes more this year?
ECB.
The ECB, 3 for 3. Simon French of Panmure Gordon. Thank you, sir. It's good to see you. TK, that is 3 people. 3 people I've asked over the last 24 hours who hikes more this year. All 3.
Yeah, John,
all 3 have said the ECB.
I'm glad you're asking this question, and to me, you know where I'm going to go with this. It goes back to nominal GDP, and I just don't see, with war, without war, how ECB can do that. It just doesn't commute in my brain. I mean, it's all there is to it.
I hear the same thing, but to Simon's point, Tom, we haven't got a crystal ball. We don't know where the economy is going. But relatively speaking, it's better now than it was 3 months ago. And we're going to see that reflected in the projections from the German government tomorrow, I expect, based on our reporting.
New high in the Bloomberg Financial Conditions Index, new accommodation, John, in the United States, and still remarkably restrictive environment in Europe. There's a massive distinction off that important set of data. No question about it. John Farrell will continue in London with us through the morning and, of course, through the week as well. It is a company from the past, and if you're an ancient fossil, well, there's a little difference with Minnesota manufacturing and mining. It is 3M, and Lisa Bramlett has been a beleaguered decade of a 6% total return. This is not the Minnesota mining of my youth.
3M shares down by about 3.5% after missing the forecast for this year for the adjusted earnings per share. Talking about cost cuts, talking about ongoing macroeconomic uncertainty. How much is that going to be the theme in a lot of the earnings we see?
Even for blue chip, Dow Jones-like companies, John Farrell knows that, there can be times of angst. There's been a decade of angst for 3M. Stay with us on earnings. Microsoft this afternoon. Futures at -9. From London, from New York, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. New tensions between the U.S. and China. Bloomberg's learned the Biden administration has confronted Beijing over state-owned companies that may be helping Russia's war effort in Ukraine. The Biden team sees evidence of non-lethal aid being sent to the Kremlin. No one involved is commenting. In Finland, the foreign minister says the government may need to reconsider whether to move jointly with Sweden toward membership in NATO. That's after Turkey's President Recep Tayyip Erdogan raised new objections to Sweden. Finnish Foreign Minister Pekka Haavisto says the primary option is for the two countries to join NATO together. In the UK, the Labour Party would work more closely with the European Union as part of a reset of its foreign policy. Labour's shadow Foreign Secretary David Lammy will outline the plan today. Some polls suggest Labour could win the next general election. The FBI says that hacking groups linked to North Korea stole $100 million in cryptocurrency last year. According to investigators, the hackers targeted the U.S.-based blockchain specialist Harmony's Horizon Bridge. Now, Horizon is software that allows crypto tokens to move between different blockchains. Those bridges became a target for hackers last year. And Bloomberg has learned that the digital asset firm Gemini Trust is eliminating another 10% of its workforce. The company, founded by the billionaire Winklevoss twins, remains pressured by a months-long industry slump. Gemini fired 10% of its staff last June after crypto prices plunged. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
We are still very much focusing on employment and earnings. I think those are the obvious benchmarks. We are very, very close to the end game here. But I think that the other issue that we would still take issue with from the market perspective is that degree of cuts, that rate cutting that's priced into the market.
Jeremy Strasser, John Farrow in London, really on topic yesterday, and of course a lot of European dynamics there as well. We're going to continue that discussion here in a moment. Right now in earnings, Lisa Bramwitz and I sorting through it all. And to me, Lisa, and I mentioned this to Gina yesterday, to me it's all about a softer revenue line. For the last 12 months, we've had the shock of maybe an organic company of 5 or 6% revenue growth, delivering 8 or 9% revenue growth, and that makes everybody feel good. It's gone.
Well, and that depends on the industry, of course, and yet we're seeing it broaden out. How much are you going to start to see the cuts really be the theme of this particular earnings season? We've already seen it with 3M. Even on the margins, J&J beat their estimate and their expectation for this year, and yet still, they also are cutting back. We also got Raytheon Technologies. Interesting when we talk about defense budgets, and they actually beat expectations, although for going forward, maybe not necessarily. So honestly, even in every single segment, it's a sort of motley picture that we're getting trickle out.
Motley picture. It's a toxic brew and a motley picture. Joining us right now, again, John Farrow in London, Lisa Bramwitz and Tom Keene in New York, to speak of the dollar. And as he well knows, it's not about up or down. It's about the times where you pause. Mark McCormick Jones is Global Head of Foreign Exchange Strategy, TD Securities. This is the one financial media likes to talk about. We want dollar strong, dollar weaker, makes for good ratings. Then there's dollar pause. Is that where we are now?
Yeah, I think we're in a bit of a dollar consolidation period. I think we got the big move that we've had since last year. I think a big part of it really has to do with the drop in the rate of change of inflation. The thing that we don't have is global growth. You're just mentioning earnings. If you look at kind of earnings expectations or earnings surprises relative to risk should be a little bit more off, and earnings should be higher. So I think in that context, when you think about the dollar, it priced out a huge part of the stagflation premium that was lingering in it towards the end of last year. But now we need to see growth delivered to get us another leg lower in the dollar. So it is about stabilization right now.
Walk us through the earnings that we're seeing right now, and particularly multinationals. And folks, I don't have the number in my head, but multinationals in America, I'm going to say 30–40% of their pie is abroad. Okay, as a general statement, that means they're dollar dynamic. What did the massively strong dollar do to those kind of American companies last year?
Yeah, it has a negative impact, just like it would on equities. So the stronger dollar, basically, the earnings that they have to bring back are lower because the euro was weaker, and then therefore they're reporting weaker earnings. So the dollar also has a negative impact on earnings, as long as it has a negative impact on growth, just like it has negative impact on commodities when the dollar's stronger. So all those things are partly going in reverse, but we have not seen kind of the change in expectations around earning that would calibrate it to the type of risk sentiment and optimism we have in markets right now.
I'm still trying to get over, Tom. Basically, you saying that it really makes for great ratings if you say the dollar's going to go up or the dollar's going to go down. This is pretty much a pretty specific,
it's a Democrats' fault. It's a Republicans' fault.
Audience. But I am wondering, Mark, is there a linearity to the dollar trade this year, or is it just chop, right? And people talk about this linearity right now of the euro gaining at the expense of the dollar because of the diverging fates. Do you buy that story?
It's a great question because I think we're out of the linear moves in FX. I think a part of it is we're very, very bearish for the dollar for Q2 and Q3. While I'm mentioning right now a bit of consolidation, I think what we're saying over the next month, most of our models that are macro-based tell us the dollar should be about 2% stronger. That's how we get back to the growth story. But in Q2, Q3, we start to see the front-loading of a better global economy, a slowing U.S. economy, a Fed that's basically moving on hold, an ECB, BOJ that are more hawkish than the Fed, and basically China reopening starts to matter because the rest of the world's accelerating, yield curves are steepening, U.S. yield curve is flat. So that is front-loaded, and I guess it feels nonlinear because we have Euro basically going to 115. And then we have Euro basically settling around 112. By Q4, though, what will matter is that we don't think the Fed's going to be cutting this year.
Right.
We also think inflation is going to be sticky. But right now we're trading the delta of inflation. So inflation's coming off, markets are getting like more optimistic. But on the downside of this, towards the end of this year, things are probably gonna be a little bit stickier in terms of the levels of inflation. You can already see it in core. So I think part of it is the linearities are gone. And we're kind of dealing with smaller cycles that will be bigger and more volatile, especially in the macro space for at least the next year.
We were talking about that last year, though, and how some of the drivers traditionally that people followed in the foreign exchange market, like central bank differentials and who was moving first and bigger and better, were kind of breaking down, and it was the economic trajectory. Although now people are painting the same story, that the Fed, as John's been asking all of his guests, the Fed is probably going to hike less than the ECB this year, and that the European scenario seems to be a lot better. How much is that enough to get beyond that 112, beyond that 115 in the euro?
So there's a point to it as well that the macro volatilities here, it's just the factors driving it are different from this year to last year. Last year was about carry in US dollar space. It was about momentum. You have not seen a momentum model make money in FX in years. It was the first time you're getting really good Sharpe ratios trading momentum. And then also the inflation momentum itself as a macro factor was in the US. All those things have changed. So if you take away part of the inflation, the thing that matters most is value. So the underlying thing that's going to drive FX, I think, that still carries over from 2022 to this year and even next year is commodities. So terms of trade momentum, the countries that are exporters, the countries that are importers. The problem is the momentum is flipped. European terms of trade is better. That's what's feeding the growth story. Japanese terms of trade is better. Korean terms of trade are better. So the Asian cycle is better because the cost of things that they're importing is getting cheaper. So therefore, like the constant driver in FX will be terms of trade and commodities. But now we are trading the extreme overvaluation of the dollar. That's very bullish for emerging markets. It's very bullish for equities outside the U.S.
John emails in from London, and thanks for watching today, John. Really appreciate that. John emails in and says he's looking in Chelsea SW3 at 10.5 million pounds. It's a little small brick thing with a Jaguar out front. It was sterling. I mean, which way does this cut for a guy who can choose whether he's paid in sterling or dollar?
That's going to be the interesting part with sterling. The way we look at it is I feel like every region has currencies and they're kind of tiered. In Europe, G10, Euro's top tier for this year. Swissie's probably second tier. Sterling, Stocky, NOK, third tier.
What does that mean, third tier?
They're going to be less attractive.
I don't want to be seen with them?
Yeah, you don't want to be seen with them. Maybe in front of the 10 million pound flat. But
some of my children are third tier. Be careful.
Yeah. Well, I have 2 tiers for my 2 kids. One is bad. But essentially, like for sterling, the way that we would kind of think about it, it does have massive stagflationary risks. The thing that's actually very interesting, though, is that it's highly correlated with risk itself. So the way that we're kind of characterizing the world is that as things improve in Q2, Q3, Euro outperforms sterling because Euro's closer to China. But on a big dollar down move, sterling's going to go up largely because U.S. dollar's going down and risk assets are rising. So I think at that point, Euro sterling goes through 90, but sterling's outperforming, other currencies that would be, closer to the dollar.
Just real quick, talking about the different tiers of children and favorites, I am curious from your perspective, the Bank of Canada tomorrow, the decision that used to be a non-starter that now is somewhat a forward indicator for where the U.S. will go. What are you looking for?
Yeah, I think Canada's going to be really interesting. I think it's more about the trading rather than the Bank of Canada providing any impulse for the rest of the world. Again, what's clear is the data's been actually pretty good. We tend to look at the employment numbers as a bit of it's about a Monte Carlo simulation. It's a bit of a random number generator, but the trend in it's been solid and core inflation remains really sticky and it came in ahead of expectation. So our view is that like the Bank of Canada still has the ability to hike rates and be more neutral and suggest that they could still hike and they still might go on the sidelines. So that uncertainty is what can be very powerful for currencies. And so the way that we're trying to trade this is we're looking at the RBNZ. So what we're trying to do is sell New Zealand by Canada, largely because we're looking for a weak inflation number out of New Zealand this week. And then what you could have is essentially this recalibration where RBNZ is the one central bank that goes from 75 down to 50. Bank of Canada is, again, going up 25, but the market thinks they could be on hold. So the rate of change is, again, the key angle here, that one goes down, one's kind of stepping up. Yeah, the Bank of Canada gets kind of exciting this week relative.
Yeah, I was going to say, we got to get you back here to talk Bank of Canada. It's heating up out there. David Dodge, the wonderful former governor, with some real criticisms of what's going on north of the border as well. I think we learned a lot about the pile of bricks in Chelsea. We did. I love the real estate listing. It's of unusual width. That's what they say. Farrell's looking at this property. It's near Arsenal. I don't know what that's about.
He's absolutely offset at this point.
It's the back kitchen of Thomas More from like a few years ago, but it's of unusual width.
Mark McCormick, thank you so much for being with us. We really appreciate it. FTD Securities.
Why don't you take us out? I'm looking at the John sent me his real estate list. I'm looking.
Oh yeah, you're looking at the real estate section. I'm actually just looking at some of the reactions to the earnings that we've been getting and wondering whether we're going to see this cost cutting continually. D.H. Horton actually disappointing for that pile of bricks.
Stay with us. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
think people are banking too much on the Fed being more modest.
We do think that we're still a long way off from the Fed really signaling any sort of even pause.
We're very close to the end of the hiking cycle, but we don't necessarily think we should be pricing in cuts for the European Central Bank, the Bank of Japan. They're behind the Fed. We've only just got to neutral in Europe.
We don't know if those rate cuts are going to come in 2023. We think it could be a 2024 issue.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow in London, Lisa Abramowitz, and Tom Keene in New York. We welcome all of you. Earnings Central, I guess is what I'm going to call it. We'll dice through the earnings today. Microsoft this afternoon, 3M, J&J earlier, a different and new GM, GE, I should say, as well. And Lisa, I want to go to what the sell side's going to do. Joe Feldman with Dana Telsey and the Telsey Advisory Group about an hour and 10 minutes ago took his price target down on Amazon from 140 down to 125, but he kept an outperform rating. That to me is sort of Feldman speaking about the sell side 90 days forward.
How much pessimism has already been baked into valuations? It's another way of saying that even with a disappointment, even with potentially less revenues or more margin compression, that's already baked in and then some. And that has been the argument for a lot of bulls out there.
I don't want to spend a lot of time on this. Verizon just out VZ, always trouble. They come in south of a 497 number. We're not going to go into that. There's too many other things to talk about. Big equity hours, so let's talk bonds here. I'm sorry, equities listen to bonds, and Lisa, bonds are speaking.
Well, bonds have actually been speaking to a disinflation, and they've been speaking to perhaps the Fed not having to go as far as people had previously thought, which is the reason why there is a sustainability in this belief that perhaps we're seeing the bottom, right? That all of the pessimism is baked in, which is the reason why you're getting a reignited push by the bulls, even in the face of some of the earnings that are coming out less than.
And the reignited push by the bulls is the bet of gloom, the short covering, but then it's what about after that? And to me, it's fascinating. Once the shorts are covered, do we once again go back down in the equity market? Up? Then we go back down. Then we go up.
This is the technical analysis of Tom Keene. Up
20.07 on the VIX. And then we're going like,
swaying up and down works really well on radio. This is the issue that people are looking at. I mean, Julian Emanuel walked in and I just said, my big question is, what about China reopening? Why is everyone talking about this as a positive and a purely positive rather than the demand for the commodities and sort of the inflationary pressure there? And that's a tension there. And there's a lot of pushback about how much demand could come back online to offset some of the pressure from higher commodity prices.
The bull case for China is scale. And I will never forget this. One of my offspring, cash flow, once said to me, Dad, you don't understand. There's 14 Pittsburghs in China. That's the most intelligent thing I've ever heard about China.
I'm learning a lot about your family, Tom. The tears of children, cash flow.
No, cash flow,
Chinese, no, but it's a good point.
It's a good point, but the answer is there's 14 Pittsburghs in China. We don't understand the size of it.
Yeah, which is the reason why the demand picture could be so constructive for the world economy.
VIX 20 is coming from a 22 level, a more constructive bull market over the last 5, 6, 8 days. We'll talk to Julian Emanuel about that in a moment. Futures at -10 for what it's worth. The yield space really going nowhere today, 3.50%. Lisa's going to give you the economic data to come in a brief. Inversion back on -72 basis points. And I'd also note oil simply resilient in a China scale kind of way. 88.37 on Brent crude. Lisa?
Yeah, and when does that become an issue in terms of demand destruction? We are not there yet, and that has been one thing. Just want to whip through what we're looking at today. 9:45 a.m. We get a read on the PMIs, both U.S. manufacturing and U.S. services, and the composite index for the month of January. We got that index, PMIs, out of Europe. They came in much better than expected at the beginning of the day. How much do we get a sort of sense that that's happening in the U.S., where you're already seeing services also turn south a bit? 1 p.m. we get the U.S. selling $42 billion of two-year notes. I'm watching this because of how much are people buying into this story that the Fed is not going to do as much as they say they're going to do. How much conviction do people have behind that bet? And then this is a huge earnings day, and we've been talking about what's been coming out. Verizon, 3M, J&J, Raytheon. Aftermarket, Microsoft really kicks off the tech earnings that we get. Microsoft has really underperformed. They've lost about 20% over the past 12 months. They're only up about 1% so far this year, even with some of the tech outperformance. How much do they give a bit of a boost to their outlook with some cloud computing?
What matters is what I think doesn't matter here. Dan Ives publishes on Twitter this morning at Wedbush, Microsoft matters.
It does matter.
Tune in this afternoon. We'll have coverage on radio and television for that. He was so good a number of days ago, we hauled Julian Emanuel back here because we didn't understand a word he said. Chief Equity and Quantitative Strategist, Evercore ISI. I want to go to the fact, folks, and we protect the copyright. I'm not going to send you out. Earnings edge. This is what Emmanuel has brought to Evercore ISI every day, the granular nature of where we are. And I want to know what disinflation is doing to your granular research note here early in earnings season.
Well, it's the revenue line is coming in. And that's really the story. And then the question is who are the companies, where are the pockets within sectors that can actually hold the bottom line, given the fact that the top line is decelerating because inflation is coming in.
You know, Zero Hedge every afternoon does a brilliant job with Bloomberg charts here, and one of them is a short squeeze chart. The last 2 days, big up equity market, we've had massive short squeeze. Then what? How do we get to the then what after we take out all the negative bets on the market?
So if you think about it, the last 2 months we are within this range in the S&P, 3,800 the low, 4,100 the high, and what it is this tug of war between the view, and rightly so, that inflation decelerating more rapidly than people expected. You know, Ed Hyman is looking for 2.5% inflation in 2023, which is very, very bullish on balance, except for the fact that part of the way that you get there is a recession. And when you think about the ISMs, you think about the leading economic indicators, you think about the money supply contracting, they're all telling you that that recession is going to happen.
But to the point of possibly seeing lower earnings and yet upgrading the forecast for the earnings target, as Tom was just talking about, how much is that gloom already priced in? A recession, a downturn in earnings, the forecasts that are coming in?
So the reason that the market has gotten off to as good a start as it has is you look at bottoms-up consensus, and it started the year at 230. Everyone knew that that was a fictitious number. Our number is 206, but I would suggest that actually in talking to our clients, the buy side is looking for more like 200. Now, part of the narrative around this short covering, among other things, is that that number could creep higher.
So we were talking about some of the cuts that we've seen, the announced cuts at technology companies. And this morning, as we get the slew of S&P companies reporting earnings, we're seeing a similar tone. Is that going to be the theme? Cutbacks, is it steep enough to get you excited?
So look, cutbacks have actually rewarded stocks over these last several months, but there's a finite aspect to that, because, you know, when you look at the way reports are coming in, there's only so much you can do to massage your bottom line if your top line's decelerating.
I want to talk to you about, not so much it's anathema to Julian Emanuel, but he's a fundamental guy working for Ed Hyman. And Ed Hyman has always believed in mixing in economics with fundamental analysis and technical analysis. Ralph Ancampora darkened the door yesterday, the technician, the giant of the CMT world, and he was heated. There was a bottom constructed in October. That's a lonely call right now. Was there a bottom constructed in October?
So what it really comes down to is, if there's going to be a recession in the next 12 months, the answer is no, okay? If the recession is going to be both postponed because we have such an accumulated level of savings, because China's reopening, because the labor market has confounded everyone with its strength, that could have been a bottom, because down 27.5 at the low in October was the average of 100 years of non-recession bear markets.
Can you fold your notorious and lonely 6.1% China GDP call over to American equity optimism?
So, and actually the interesting thing is our China guy took his number down to 5.9 because the fourth quarter of 2022 is going to be better than expected, reported better than expected. And what it is, it's less a direct effect on the U.S. economy and more a psychological boost, because you look at the greatest names in corporate America, one of which is reporting next week in between the Fed and the unemployment report. And if those stocks do well because China's doing better, that's a wealth effect in the U.S.
Just real quick here, because this has been a theme over the past couple of days and weeks, is people are moving toward Europe as the outperformer this year. Do you buy that with the China reopening disproportionately affecting that region?
We buy that. We buy that. And the interesting thing is, some people might say, well, the ECB is now the most hawkish central bank in the world, and that is probably true looking at the next 6 months. But the fact is that you are absolutely ridding Europe once and for all of the psychology of negative interest rates, and that is a massive positive for equities long term.
We have a big take story out this morning, folks. This is from our crack Federal Reserve team and bond team, Liz Capel-McCormick, writing with Janelle Marty as well. And this is outside your purview, but this is something Mr. Hyman's looking at, and he has debt ceiling experience. If we have a debt limit fight, as the headline goes, does it mean the end of QT? Does it radically adjust the Fed policy that your shop sees?
Well, it certainly ups the stakes with regard to what the chairman's going to say on February the 1st, because there's no question that he's going to be asked about that. And look, the part of the bull case of the last month is that there are cuts priced in the back half of the year, lots of cuts. Are those only going to be in response to a debt ceiling debacle, or are they a consequence of an economy that would be turning down naturally? It's really an open question.
Earnings season, earnings edge as well. What's your earning edge going to say when you write the last report for Q4?
It was a sloppy season, much more closer to the pre-pandemic normal. Numbers are coming down, but again, at the index level, not as important. It's all about picking stocks in this environment.
Julian Emanuel, thank you so much. Really, really appreciate that this morning. We're going to continue. There's lots going on here, including a tape deterioration. -7 has become -12. VIX not giving me much right now. I'm watching oil, $88.35 as well. John Farrow is in London. He will have further conversations for us from London and joining 124 sterling. Good morning. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Poland has formally requested Germany's permission to send its German-made Leopard tanks to Ukraine. That comes after weeks of pressuring Germany's Chancellor Olaf Scholz to drop his cautious approach to delivering the tanks. German law requires approval for the re-export of military equipment. Bloomberg's learned the U.S. Justice Department is set to sue Google as early as today. The case has to do with the search giant's dominance over the digital advertising market. Google controls most of the technology used to buy, sell, and serve online advertising. The company has argued that the market is a crowded and competitive one. In the UK, there's more evidence that the economy probably has slipped into a recession. British companies signal that output has dropped at the fastest pace since the start of the pandemic. Meanwhile, the government's budget deficit rose to a record. Soaring interest rates have jacked up the cost of debt service. In Half Moon Bay, California, police arrested the suspect in another mass shooting. 7 people were killed and 1 was wounded at 2 plant nurseries. The 67-year-old suspect was believed to have been a worker at one of the locations. Meanwhile, an 11th person has now died from the shooting at a dance hall in suburban Los Angeles. The suspect in that shooting killed himself. And General Electric forecast profit for 2023 that missed estimates. The slimmed-down manufacturer will strengthen its focus on aerospace at a time where there is sustained demand for air travel. This will be GE's first year without its healthcare division, which was spun off this month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number. Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This has quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
It can't be negotiated over whether or not we're going to pay our bills. And not to do so would have devastating economic consequences. So I believe in the end we will find a way around this, and Congress will act to meet what I believe is a shared bipartisan responsibility to raise the debt ceiling.
Secretary of Treasury, who runs the Treasury of the United States and tells Mr. Biden what to do, particularly on economics and finance. Bloomberg surveillance is no different. Bramo tells me and John what to do on a daily basis, and you just lay down the law. It's time to talk the debt ceiling. We're going to get right to it. A quick market check. Futures -11, Dow futures -101. Dollar fractional, I'm going to call it. Euro 108.65. McCormick at TD Securities talking up a 115 euro for a cup of coffee at some point. Stronger euro.
That's basically the consensus right now. Go into Europe, and how much has that been the underinvested trade, the widowmaker for so many years that might actually make the bank this year?
Right now, on the debt ceiling, debt limit, this, that, and the other thing, and particularly with Liz Capel-McCormick and Janelle Marte's wonderful Bloomberg story today on what it does to Fed policy. Maybe this time is different. Emery Horton joins from Bloomberg, Washington, our chief debt correspondent. Is that right, Anne-Marie? Forget about 2011 and the memories of a really challenging time. How different is this time from the other times?
Well, I mean, the thing is, we actually don't know yet, right? A lot of what you're seeing right now is grandstanding. So we do not know yet. It is still early days. We obviously know that the Treasury is using these special accounting measures, and really this summer is when it's going to get difficult. The reason why everyone is so concerned that this could be different when it comes to the debt debate is because already this is a different Congress. Electing a speaker usually makes no news. This time, it was the main headline of the start of the 118th Congress, because you have a group of rebels who are holding Speaker McCarthy accountable also for the backroom deals that he said he is going to work out. And if he doesn't do that, they now have a one motion to vacate. So this is why the politics have become very difficult. And you have to give it to both these sides, because they're really drawing the battle lines right now. But then you have the Senate Republicans who they've raised the debt ceiling last time. And there was a little bit of back and forth, but there was no drama. And they're really saying hands off. This is going to be Speaker McCarthy, and this is going to be his debate with the White House and the Democrats.
You know, I'm going to lean on, Maya McGinnis here with Bloomberg. Joe Matthew, I think, does a great job on Sound On. But Anne-Marie Vallier, as usual, in his New Hampshire way, cuts to the chase. They're talking about, a ballet from 30 and 40, 50 years ago, generational. And as he says, and I quote, astonishingly, non-defense discretionary spending. One more time, take out the Pentagon. What we can really choose and decide in the white marble of Capitol Hill spending is 16% of outlays. Are they going to go after entitlements?
Well, they might be saying they're going to go after entitlements. It depends really who in the Republican Party you're talking to and asking about this. But again, that can also show blowback from the population, from their constituents. This is what Senator Manchin was also talking about at Davos. He said, you know, you'll scare the bejesus out of people when you say you're going after something like, say, Social Security. So it remains to be seen what exactly the Republicans want to cut. But they at least want to get in a room and have the conversation about spending. But to be clear, we have a debt because of both parties, right? There has been spending on both sides. There's been tax cuts on the Republican side, there's been spending on the Democrat side, and that is why we have the position we're in now.
And meanwhile, we see extraordinary measures being taken by the U.S. Treasury Department as they try to stave off some sort of default. Yet, Secretary of the Treasury, Janet Yellen, is in Africa. Why?
Well, she's in Africa partially also not just to shore up alliances that this administration has in Africa. Biden had this Africa summit, but also this is really a geopolitical play. And she talked about this on her first trip, her first stop on the trip, which was Senegal. She talked about the fact that Russia is not helping the African economy and is actually making it worse. And then she also talked about how China is not a friendly and a good lender. So what you've seen from Russia and China, these two countries have really made inroads in Africa. And it's an interesting time for Secretary Yellen to be there also because South Africa at the moment had just had Sergei Lavrov invited, and now she's coming on the heels of that trip. So this is really a geopolitical play, and Africa is going to be incredibly important to the United States as they electrify their grid, right? Like, this is a place where China is able to get a lot of minerals and natural resources.
This is fascinating to me at a time when you speak with the business leaders of the United States and in Europe, and they're excited about the reopening of China, re-accelerating their push into there. And then you hear the U.S. saying that Chinese companies are helping Russia's efforts, that Chinese lenders aren't necessarily good actors in places like Africa and South America. How do you put these two stories together when you have the business community warming back up to the world's second biggest economy, and you have an administration that has bipartisan support to move in the other direction?
It's a very difficult conversation. I think it's a very difficult conversation lawmakers have with these businesses. It's a difficult conversation when a lot of those businesses want to also spend campaign and give campaign money to certain politicians. But the fact of the matter is what you do see in Washington is they want to make sure they are controlling that competition with China. And the business community, I know, really wants to go full on in. And it's difficult, and there's going to be very difficult conversation. At the same time, Secretary Yellen just met with Liu He in Zurich. She's now talking about how China is not a good actor when it comes to Africa. We also have this story out today from Peter Martin and Jenny Leonard talking about what the administration is confronting Beijing, and they want to make sure they are ascertaining this correctly. But what they are potentially seeing is that these Chinese companies are aiding Russia in non-lethal military and also economic aid. So this is really coming close to that sanctions line. And this is already worrying the administration because Beijing and Moscow said before the war they have a no-limits friendship. And this is really going to be Putin's last friend in terms of mightiness and what they can help in terms of any sort of aid.
Thanks so much. Greatly appreciated this morning. Emery Horton in Washington. We're talking about use of cash. We were talking with Margie Patel about that yesterday. Really expert on the linkage of bonds over to equities and who's giving you the best use of cash. 40,000 bodies, Houston, Texas, Halliburton, flat on their back for years in the energy shortfall that we had. And obviously better. Stock's gone like 25 to 40. I know you loaded the boat on that, Lisa. A dividend pop up 33%, and it's again that use of cash. Do you do it through dividend, share buyback after options compensation to executives? And again, there's a dividend lift. You wonder if we'll see more of those.
Well, especially in the oil and the energy space in general. And that's something that we have seen, that's the dividend play very much in the fossil fuel producers that people are looking at now that are throwing off money, that don't know where to invest longer term. And you see this pretty much across the board.
ExxonMobil, a yield of 3.2%, 5-year net growth, which is back to the gloom of oil, 3% per year dividend growth doesn't get it done. And I just wonder how that metric's going to go. Let me give you one statistic here you're going to love, Lisa. I can bring it up in the Bloomberg terminal on the FA screen. They've only got $60 billion of free cash flow to decide what to do with.
It's such a tragedy for them. Honestly, though, this is really a story of Halliburton, yes, but also oil majors more broadly. And to me, when I hear about people being bullish on energy companies, energy stocks, regardless of where the price of oil necessarily goes, that's the reason why. It's because of this free cash flow that they're going to pay out through dividends.
Can I suggest that the British do this better than we do? We say 60 billion.
Suggest that every day.
No, we say 60 billion, and they say 60,000 million, which makes it much more like I can grasp 60,000 million.
Grasping it right now.
Much
in the air.
better
60,000 million?
60
okay, so then do it
billion.
that way, you know? 60,000
We're
million.
British. Speaking of Britain, John Farrow in London. We'll get to that. Good morning.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg. Bloomberg surveillance in London, in New York, we welcome you. Mr. Farrow with some important conversations. And of course, his 9 o'clock hour no doubt will be better than what you're seeing right now. Look for that. Lisa and me here, and we're going to get right to it because we're going to talk about Maury Harrison, UBS there. Julian Emmanuel with us and Drew Mattis coming up. But I want to slow it down and talk about really the first blush. I mean, big bank, JP Morgan, Bank of America, Apple, Amazon. That describes earnings on financial TV. There's other companies.
Which is the real nuts and bolts of what's going on. And
in America.
Is a motley picture. I'm going to keep going back to that. A motley picture of cost cutting and dividend growth when you look at some of the energy companies and when you look across the board at others that are more traditional businesses, cost cutting really in the front and before. Raytheon came in a little bit softer than expected with their expectations. If you take a look, they are splitting into 3 different units. How much, with your adapting and your adjusting, Tom, do you start to see more of this? The spin-offs, the readjustments, the closures of business, the job cuts. Raytheon shares up about a 1.2%.
What Jamie Dimon said in one of his notes a couple years ago, the hard work of actually running a company.
But that's exactly right. How much do we start to see that, the rationalization of parts in a way that we hadn't during the era of free money? Halliburton shares up 0.8%, basically in line, a little bit higher than estimates when it comes to earnings. 3M, I think, is probably one of the most interesting earnings reports that we got this morning, because what you saw was both the foreign exchange headwind, which might turn to a tailwind, by the way, this year if you see that ongoing dollar weakness continue, but also cost cuts. And how much do we continue to see this? They are cutting costs across the board. Those shares lower by more than 5% due to a disappointing earnings forecast. And Verizon shares were disappointing, trailing the profit estimates of Wall Street estimates, and those shares down 2.7%.
Let's get some, we can do this, folks, on the Bloomberg terminal. Look at the terminal on Twitter is very good. And I've got it, you set up some presets and all that are secret. I don't know how they did it. I've got a guy that comes in and just helps me on this.
Yeah.
Like
while we're on air.
No, yeah, sometimes while we're on
air.
Please, Verizon, 10-year total return, 5% per year. Is that acceptable?
Well, is it acceptable in this era where you've got inflation that's higher than that, at least for the past couple of years? But I want to flip it on its head a little bit, because we're talking about Apple, and those results. How much is this tied to perhaps not as much demand for certain mobile phone services, broadband services? How much does this feed into the glut that we saw during the pandemic that's getting sort of...
Microsoft, same algorithm, 23.6% per year versus 5% at Verizon. Stock selection matters, as Julian Emanuel.
Verizon's also been losing market share to AT&T and T-Mobile.
This is a wonderful moment and a real hallmark for us after the pandemic to have Drew Mattis of MetLife join us. He's chief market strategist. But what's really wonderful, to give you a little bit of heritage of what we do here, Neil Duddick comes in as one example of a bona fide optimist. Drew Mattis is a bona fide optimist and that every day he's looking at the American economic experiment as a glass half full. Who invented this? At UBS, long ago and far away, I think it was even called the Union Bank of Switzerland then, a guy named Maury Harris took a bunch of young Turks, and they won so many awards over so many years, Mattis had to get a structural foundation adjustment on his house. They were that good in their optimism when everybody else was gloomy. What did Maury Harris do? What was it like at UBS years ago? You and Julian Emanuel, you walked in and the Texas optimist said, let's go. What was it like working for Dr. Harris?
Well, it was a matter of following the data and see where the data leads you. And don't be quick to dismiss things that go against your narrative, right? And so that way, even if you're wrong, you're not wrong by much. And I think, if we look at the current environment today, the narrative of recession, as much as it's kind of the consensus call now, it's the one that makes the most sense.
You beat me up once. Sometimes he wears a bow tie, in case you know this. We're having a bow tie-a-thon at lunch or something, and you said high-frequency data matters. The mother of all high-frequency datas now, his initial jobless claims, is a killer number. How do you interpret that?
Well, so that's the one that we're having difficulty explaining. But if you look at other series, some of which are quite good, ISM surveys are some
Farrell
of my favorites.
Is Farrell? John Farrell, thank you.
Yeah. Both of them are now below 50. Now the service sector one's only been around since '98, but if you look at history, every time both of those are below 50, we're in a recession. So maybe the debate shouldn't be, are we going to have a recession? Maybe we actually should be having a debate, are we in a recession and something is holding up the labor market? And how long can that something hold the labor market up for?
But if this is the recession, isn't the optimism warranted because it's not that bad?
It is, but this could be the first step, right? I think what's happening is there is a calendar in the corporate world, and it's not the earnings calendar necessarily, it's the planning calendar. So most large corporations plan out their hiring and headcount a year, 2 years, 3 years in advance, and every year they then adjust. And I think what's happening is the weakness really became more pronounced, and concerns about corporate margins became more pronounced in the fourth quarter, right in the middle of that planning process. So do you rapidly accelerate the planning process and perhaps make some mistakes? Or do you follow through on the planning process like you were planning on and execute at the beginning of the year? And I think that's the lag that we're going to see in the labor market.
So as someone who's responsible for MetLife's investments, how do you sort of go with your gut at a time when other people are going in the other direction? How do you execute your belief?
Well, so I'm not going with my gut. I'm going with the data. The ISM data is I think, compelling. Corporate margins or economy-wide margins are actually in decline. All right, and so when they begin to decline, what kind of decisions are starting to get made in the C-suites? If you look at CEO confidence in the economy 6 months out, it's at an all-time low. All-time, like history of the series, all-time low. Does that strike you as an environment where people are really going to be gearing up for the hiring story?
So you're not buying stocks?
No, I mean, I think, if we look at kind of the most recent kind of relative value assessment we've done, treasuries, munis, resis, those all look good. Some parts of we're very involved in privates, so private corporates and private ABS, et cetera. We like private ABS. And to be frank, cash is compelling for a lot of people right now, and it's complicating a lot of people's decision making, because you probably have people who are on Wall Street making investment decisions who have never had cash as an alternative that actually yielded anything.
I want to go to the sweat at MetLife and every other responsible long-term investor. 2022 was original. Some people take it back to 1788 in the bond market. Certainly the 60-40 model was a train wreck. Will you have to switch your actuarial assumption based on the carnage of last year, or can a conservative pile of money heal over, say, 36 months?
So I think one of the advantages to working at a firm like ours is the
Giants tickets.
It's the length of time that you have to consider when you're making an investment, right? And it naturally lends itself to not falling into the idea that this time is different, that things are sustainable when they're not. It can actually lead you to think like, hey, you know what, we have to be prepared for a low rate environment over a long period of time. But is this something that's really going to be the new world order? And the answer was, of course, no, right? And so I think, investing over a long enough time horizon, it kind of smooths out what may seem like big cliffs and valleys in the financial world. They actually look a lot shallower or less impactful when you actually take a step back and look over a long enough horizon.
What's your GDP call now? Do you publish within Met or outside Met? Give us a window into, are you sub 1% real GDP growth, or can you be more constructive than that? Out a year, out 2 years, out 5 years?
So we're at 0.3 for the coming year. We expect a recession starting kind of end of the second quarter and kind of following in through the second half of the year. We expect the labor market will begin to weaken, probably with the release of the February and March data in April and May.
Do you think that we're going to avoid some sort of financial accident that everyone was talking about last year?
I don't see the need for a financial accident to take place, but at the same point, as I said, you have a lot of people who have never seen cash as an alternative, or as a realistic alternative to a lot of the investments you can make.
So what is your cash type of holding versus what it had been, say, 6 months ago? Have you been building it? Have you been accelerating it to some of the bigger ones you've seen?
Well, so that's not something we actually do as an insurance company, right? You bring money in, you put it to work, and so we're very in the weeds in credit and making sure that we like the things that we're in and we're comfortable with the credit risk we're taking. But when we do a relative value assessment, you have to assess cash, and that assessment obviously has been improving because the rate of return on cash is improving.
In other lives, you were heated about the dots. Are the dots efficacious now, or should they be discarded by the Fed?
Well, if they are, what they're telling you is they're going to be cutting rates well before inflation drops anywhere close to 2%. They're telling you that. That's not me. That's their dot plot is telling you that. And yet everyone assumes that they're not going to do anything. They're going to be able to sit for a really long period of time, even as the economy withers. And I don't think that's going to be the case.
Interesting. Drew Mattis, wonderful to see you. Really a pandemic sign for all of us at Bloomberg Surveillance. Somebody who's been with us for decades. Drew Mattis is with MetLife as well. What did we learn there?
The idea that cash is an alternative, perhaps not to put your money, but as a comparison versus equities, versus bonds, versus credit, and what that does in terms of putting a higher bar for taking risk.
I learned how many people listening and watching can encourage a 36-month perspective. I would say it's single digits. We have become addicted to, some people 3 days, some people 3 months. 9 months is long-term now. 18 months used to be long-term.
Okay, but people used to say...
Guys like MetLife are 3 years.
People used to say it was harder to predict short-term than long-term. And what I'm feeling is that it's getting a little bit harder to do longer-term than it used to be. And that people are less certain about whether we have a more protracted inflation or whether we get back down to something that we're used to. And that really is the argument on the long-term that's being had in a new way.
And I would suggest so much of that's coming out of the pandemic is to see Drew Mattis in our studios today, another symbol of that. Let me do a data check. Futures at -11, the VIX 20.03. Not much going on here. Yield 3.5%. 10-year yield has been unchanged for a month.
I do want to just bring you this. A viewer writes in, tell TK that we don't do that anymore. 60,000 million is not a thing anymore in the UK.
I'm stuck back with, Windsor and Albert and Victoria.
60,000 million. That's like
The
I've never
rest
heard
of
that.
60,000 million. What else do we have? Oil, 88.67 from London with John Farrell, Kona Hake.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New tensions between the U.S. and China. Bloomberg's learned the Biden administration has confronted Beijing over state-owned companies that may be helping Russia's war effort in Ukraine. The Biden team sees evidence of non-lethal aid being sent to the Kremlin. No one involved is commenting. In Finland, the foreign minister says the government may need to reconsider whether to move jointly with Sweden toward membership in NATO. That's after Turkey's President Recep Tayyip Erdogan raised new objections to Sweden. Finnish Foreign Minister Pekka Haavisto says the primary option is for the two countries to join together. In the UK, the Labour Party would more closely with the European Union as part of a reset of its foreign policy. Labour's shadow Foreign Secretary David Lammy will outline that plan today. Some polls suggest Labour could win the next general election. The FBI says that hacking groups linked to North Korea stole $100 million in cryptocurrency last year. According to investigators, the hackers targeted the U.S.-based blockchain specialist Harmony's Horizon Bridge. Now, Horizon is a software that allows crypto tokens to move between different blockchains. Those bridges became a target for hackers last year. And home builder D.R. Horton is reporting weaker than expected quarterly orders. Now, it's also warning that housing market pressures may persist into the key spring selling season. D.R. Horton has been stepping up incentives such as price cuts and mortgage rate buydowns. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
You focus on China, that's the right focus. It is the main destination of illicit exports by Iran. We've been in contact with the Chinese authorities and will continue to take steps to sanction those who are involved in the import of Iranian oil.
Mr. Malley, Robert Malley of the State Department, Special Envoy for Iran, and we're thrilled that he could speak with Bloomberg yesterday. I'm not going to waste a lot of time here because every minute is important for John Farrow in London. The futures at -11. Oil with a lift, getting near $90 a barrel, but there's much more, a richer discussion of commodities, including John Farrow's industry-leading analysis of copper. This is an important conversation this morning in London. Our John Farrow with Kona Hake of ED&F Man. John?
Hey, TK, thank you, buddy, as always. I want to talk about two metals, not just copper, but aluminum as well. Year to date, these two off to the races, absolutely flying. At the moment, year to date, copper up more than 11%, aluminum up more than 10%. We are just 3-4 weeks into this. Kona Hack joins us right now. Kona, let's talk about it. I want to start with this. It's a big picture question. It's an important one. How commodity intensive is this reopening going to be in China?
Well, that is actually the big question. I sense that right now it's very sentiment driven. The idea of China reopening is definitely going to lead to a lot of pent-up demand, just like it did when the US and Europe opened up after COVID. But in terms of actual manufacturing intensity, which requires the huge amounts of commodity imports, I feel like China's commodity imports are still pretty good. I mean, their stock levels are really quite high right now. So I think right now it's potentially the copper rally is running ahead of itself in anticipation of more to come. But I think we just have to be a little bit patient on that.
So when you hear Jeff Curry of Goldman say 11,500 this year, you're pushing back?
I think short term, I think we might have run ahead of ourselves. But I do agree that copper fundamentals are tight. Inventories are still pretty slim. The supply side still looks like there's a huge amount of capex that still is required. But I don't think we're at crunch time right now. But I think right now it's very sentiment driven. And I understand it's all thing China.
When you look at the marginal dollar increase of China GDP, has it become more or less commodity intensive over the last decade or so? Is that something that's declined?
Yes. I think China's reopening is significant, but it's going to be a different China. The structural changes that we're seeing in China, I mean, we've been talking a lot about the population decline, the fact that the property sector is no longer as hot as it was before, the manufacturing is slowed down. There's no longer that big impulse and push, you know, to go back to your point about intensity of consumption of copper. I just don't think it's going to be as strong as the 2010 rebound, for example.
Well, talk to me about where you do want to be. What bucket do I want to be in right now, preparing for the demand that's going to come? Where's that demand going to show up?
Oh, so I do think commodities are a good place, and I feel like copper and alloy have, you know, slightly gone ahead of themselves. I think crude oil is justified because, you know, right now, it's particularly ahead of the February 5th European ban on Russian products. I think China has a huge role to play there, so they're going to be importing more crude in order to meet that gap in terms of product exports, and they're doing that in a big way. I think mobility in China is just starting, and that's going to be, again, very oil intensive. So I like crude oil very much. I think to a certain extent, ags as well. I think as they start, the Chinese go out and look going back into restaurants and consuming what they couldn't maybe back in lockdown. I think that could be quite good for the beefs and therefore the feedstocks, which is the grains.
Triple-digit crude back on the table?
Just about. I think we might touch 100, but not necessarily go higher.
The reason I asked that question is because we're all trying to figure out how much of this we import to the United States, to Europe. Do we import higher prices from what's happening in China right now?
And that is the risk. So I think, yes, there's a potential that we see a little bit of an uptick in commodity prices, but for the reasons I mentioned before, I don't think we can sustain higher because the rest of the world is moving into recession. So we're just a little bit too China-centric right now. And I think we need to balance that out by the fact that the USA and Europe are slowing.
When you say the rest of the world's going into recession, who do you mean?
Okay, good question, because the idea is, at least the bond markets are telling us that Europe and the USA are going into recession. Maybe a mild one, but it's still heading that way. The yield curves are definitely pointing to that. Obviously, don't look at the stock markets and think that everything's great and rosy. But I think if we are paying attention to PMIs, and maybe not today's European one, but US PMIs are going to come out later today, if those start showing continuous contraction, I think we are looking at a recession, and I think even if it's mild or not, it has to be taken into account, and that might have an offsetting balance to any China reopening.
The markets are playing a relative game. Are things better or worse than they were 3 months ago? Clearly they're better in Europe. One thing I don't think we've discussed enough is the fact that Europe is still projecting, 0%, 0.5% GDP growth for the year ahead. Why aren't we talking more about stagflation? Why is that word not being used a whole lot more?
Actually, if you talk to some hedge funds, they are talking about stagflation. And it's interesting because in a stagflationary environment, you want to stay long some commodities, but you also don't want to stay commodities that are economically dependent. So in that case, something like ags could do quite well because those are income inelastic. So no matter what happens to your economy, you need a certain level of agricultural foods. So some people like agriculture in their basket as a good hedge against stagflation.
So you'd prefer a long in soft commodities as opposed to a long in base metals?
Good one. Yes.
Interesting. That's the year ahead conviction call for you and the team. Conor Hack, thank you, a VDNF man. TK, some really nuanced stuff there about the year ahead, but I think the point that is most important to us and all our viewers, our listeners as well, is just how commodity intensive this reopening is going to be in China. You can see the sentiment story. Connor's talking about that. The metals are absolutely flying. Copper at more than 11% year to date, aluminum at more than 10%. But is that just a sentiment story? Will it be backed up with real tangible demand, physical demand later this year?
I get the flows, John, are really, really critical. I just want to give you small understanding of that after what we saw from the president's trip to Mexico. Somebody handed me, John, my Tang from Puebla, Mexico, east of Mexico City. This is Mondelez, Mexico, and this is a tangible Tang example of the kind of commodity flows. I mean, I didn't want you to ask Conor Hack about Tang futures, but this is, again, the import-export dynamic, John.
Yeah, I'm not sure that's what she was talking about, Tom, and I think those sachets, because I was with you when that fan gave you them, they're from San Miguel.
San Miguel.
To be precise. San Miguel.
Okay, I'll go with that. Thank you, John.
You should check it out sometime.
Thank you so much. But this is underdone, folks. With a great Bloomberg commodities team, we don't do enough on commodities to have Conor Hack with us in London, the land of commodities. As John looks at LME, copper is really, really, really quite important. Futures -10, Dow futures -90 here as well. Lisa, I think we've got to digest this, and that you say to yourself, what could topple the apple cart? And as you've been very good about the ambiguity of a China opening, and if it cuts the wrong way, you get a super cycle commodity lift. No one really predicting that, but there it is. If you get it, that changes the story.
I was speaking with Nicolai Tangen last week, the CEO, the head of the $1.3 trillion sovereign wealth fund of Norway. And he basically was saying this is the worst case scenario for risk assets. China coming back online, re-accelerating inflation, leading to this stagflationary outcome that John was talking about, and nothing does well. And he's tied to the market, and he's got to just be vulnerable to it. But to me, that's fascinating, the sort of risk case scenario that people are not talking about.
You know, I'm hardwired that if you get commodities, industrial metals, copper, you know, aluminum, as John was mentioning, but if you get them to lift, that's always got to be good for the system And I don't see anybody predicting out of control commodities, but are we even modeling in commodities as Ms. Hake was talking about?
It's a great question. There's also the political risk, and I do want to bring this up, especially because this headline just crossed about Ford in talks to sell a car plant in Germany to China's BYD. And I find this fascinating, especially after the potential layoffs that Ford was talking about or that was reported in Germany. How much do you start to see this? I mean, China increasing their presence with respect to the demand for German auto manufacturers at a time of increasing political tension. I mean, honestly, this has been one of the biggest conundrums that I've seen, where on the political side, pretty universally, people are talking about pulling back from the West and the East and creating a greater divergence. The businesses are going in the opposite direction.
What was your take on the labor dynamic and investment dynamic on your trip to Mercedes in Germany?
That they have to see China's sales. That actually is a key component of their overall business, one of the major businesses that they have, and they are going to cater to them. Do you know one detail? There are different kinds of cars that sell with Mercedes in China because most people have drivers who can buy a Mercedes. Well, and so they build a bigger back seat
they do.
for people that they sell. You know. Oh, is that right? In your Bentley?
You know, in the you accommodate as you can, but you know, seriously here, I look at what I mean. Is there we got to talk about this later. We got to run here to a break here to pay for the show. But the basic idea here, Lisa, is there a bipartisan anti-China feel in Europe like there is in America? We'll discuss that here. Brammo wants to go there. It's a motley day. Stay with us. This is Bloomberg. Good morning.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, you know, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, you know, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're very much in this steady and significant policy narrative.
We've seen a disconnect, right, between market expectations and the Fed's hawkish announcements.
We think inflation is going to continue to trend lower. We think as time progresses, we will see those Fed rate cuts.
25 basis point increase, and that will somehow cause no recession to occur. So I think people are being too optimistic about that.
I think the Fed's goal this year is to be boring, and I think they're on track for it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. The earnings parade ramping up. Tom Keene, Jonathan Farrow in London. I'm Lisa Abramowitz, and the rubber is literally meeting the road, I would say, with actual earnings of what companies are doing from actual companies to understand what the economic picture for them is right now.
Yeah, Lisa knows the school I'm in. I'm in the school of James Dimon and Brian Moynihan, particularly Brian Moynihan, I'd say, at Bank of America, which is listen to American business. Dimon has a jewel in James Glassman and JP Morgan Commercial Banking, listening to American business. And what we've heard this morning is diminished revenue growth, normal, disinflation coming in, and then sector to sector, company to company, failed business model, the word you're using this morning from Motley Crue. The Motley scene that we're in, every earnings story is going to tell a story.
And it's going to be job cuts for some. It's going to be cost cuts in other ways. It's going to be what happened over at Raytheon, where you divide businesses and try to concentrate certain efforts. You have a host of different issues that are coming to the fore as companies are really challenged. And what does this say about the gloom that's priced in? What you're seeing is a motley picture on that front, too, with really differing kinds of price reactions.
Yeah, well, and it's not the time of Nikki Sixx. I mean, you know, playing bass for Motley Crue. It's a time of we're moving forward with a China reopening. And I'm going to throw this out there, something I think new for us, with a new globalization that was barely touched upon in Davos.
Well, this is, to me, the most important issue that we were talking last year about the divergence between the East and the West, this idea of, you know, repopulating supply chains, of the, you know, deglobalization. That's not what's happening. And we are seeing that time and time again from one company after another, perhaps in the margins, but not very quickly. So what does that say in terms of where business revenues are going to get derived from and how important China's reopening will be?
And what's important here is it wraps around tech earnings with Microsoft leading up this afternoon on to the end of the month, even after the Fed meeting. Some of the big names come in, like Netflix before, like Microsoft today, and all of that wrapped around the commodity dynamic that John Farrow just spoke about with Kona Hake.
How much will the China coming back online cause demand for oil prices, for commodities more broadly, cause some sort of reignition of inflation? I mean, we really haven't talked about that all that much. Today, we are seeing a bit of a softer tone, but yesterday was telling in terms of the rally, even in the face of
two days in a row. Come on, Friday, Monday, the quality of the rally was whoa.
I would agree, especially with some disappointing data, with the leading indicators coming in perhaps softer than expected. We see the S&P down 11.40.25, breaching, though, that 4,000 mark. Remember when people thought that was way off the mark. So, yes, down today by about 0.25%, but not much to write home from given the recent rally, even on the heels of negative news. The NASDAQ also lower. You could see that euro strength perhaps fading just a touch. But again, 108.60. Mark McCormick on earlier, Tom, talking up 115 for that euro, a real retracement of what we saw with dollar strength last year.
And then the boredom of the McCormick presentation was this idea of not about strong dollar, weak dollar, but just pause and churn. And maybe that provides stability for businesses to adapt to what Drew Mattis talked about, which is we're coming out of the pandemic, and what kind of normal are we going back to? To me, that's a huge theme of the first half of this year.
And the uncertainty of that. The other theme that I see is really the euro strength and the European strength, and everyone piling into this story because the reopening of China, that's why he's there. The reopening of China, because it's, you know, the strength of Europe. It's the reassertion of the European.
Talk yet?
Yeah, well, we'll get there. I do want to, though, question this narrative. At what point does a colder winter, does more demand for commodities, really pressure a Euro region that's facing a lot of potential headwinds. And I want to start there with Brian Nick, Chief Investment Strategist at Nuveen. Brian, do you pile on to this long Europe trade?
Not yet. We came into the year underweight, Eurozone underweight non-U.S. developed assets in general. We've obviously seen a pretty strong decline in the U.S. dollar, and a lot of that has been to the benefit of the Eurozone. But if we're just relying on the weather here, and I think what's going to be a very uncertain opening in China, our people on the ground there see a lot of economic activity currently, but with the Lunar New Year and with uncertainty about just how long that's going to last, a lot of the things that are holding up that European trade right now are, in our view, iffy. So we're not ready to go to neutral, let alone overweight on European assets just yet.
How is that being expressed? Is that sort of a long dollar call, or is that just hunkering down in U.S. assets and waiting for the recent turmoil to pass?
It's more of a where we're putting the assets instead. So we're talking about being more overweight U.S., which has not done well earlier this year, but with the tech trade doing better, that's going to tend to be better for U.S. equities, and then mostly just an overweight to fixed income generally. So we put more of our eggs in the fixed income basket. Starting at the end of last year, coming into this year, that trade's done well on a risk-adjusted basis. So we may have to revisit that because right now we had been talking about bonds over stocks from a valuation perspective, but given the run we've seen in bonds, neutralizing that view may make more sense.
Brian Nick with us with the Nuveen on radio and television. I do want to point out just as one ginormous move that we've seen, I think underreported in financial media, natural gas NG1, the core U.S. contract, down 63% from the August angst that we had last summer. Brian, Nuveen owns the absolute high ground on muni bonds and fixed income, careful management of fixed income investments forward. How does your world change now that money costs something? How does your world change that LIBOR's up and we've got a legitimate risk-free rate?
For the muni market, the number one concern we have, the thing we point out to clients is that there's going to be less issuance because you have a lot of states and localities that are sort of flush with cash. They were borrowing money, like to your point, when it didn't cost much, but now with interest rates higher, you're going to have a lot of these areas that are more reluctant to borrow, and issuance is going to be constrained. We think it's going to be positive for holders of municipal bonds. It does make the market a little bit less certain in terms of liquidity. There just isn't as much paper out there, and we think that issuance is going to stay constrained for a while. On the flip side of that, though, as long as you have interest rates moving up, you had a reluctance on the part of retail investors to engage in the asset class. What I think you start to see now is with rates falling, more retail investors getting in because they feel like the playground's a little safer now.
Brian Nick, I'm going to say 40, if not 45 years ago, I was shaving one day a week. It was the last time the Cubs won. Brian, I had Sir John Templeton say there will be a shortage of bonds away from government, full faith and credit. In municipals, in investment grade, will there be a shortage of bonds?
We don't see an outright shortage at this point. There's still a lot of this paper out there. We know that the Fed is undertaking quantitative tightening. They're certainly keeping an eye on this. I think there's going to be a moment here between when the Fed stops hiking and when they start cutting that they're going to be stopping that quantitative tightening program. So that could also be a liquidity adding measure if they stop earlier than the markets are looking for. So we don't see the shortage just yet. And also, we're in a different environment than we were just after the financial crisis when there was a genuine shortage of high quality paper because everybody was hunkering down. If we feel like the environment's going to stay a bit better this year, there's going to be not as much of a demand for that safe, ultra safe investment, government bonds, longer duration, higher quality municipal bonds, the things that people really flock to when it looks like the macro scenario is falling apart.
There's a story on the Bloomberg this morning that Tom was talking about earlier that caught my attention as well, by Liz Kappa-McCormick and Janelle Marte, about how potentially quantitative tightening might be ended early because of the debt limit debate, because of the disruptions sort of foisted upon the market from that whole drama. Do you see that as a likelihood?
I wouldn't call it a likelihood yet. I'd call it a possibility. I think the Fed wants to stay as far away from this debate as possible. I think Secretary Yellen did the Fed a favor by disavowing the platinum coin, the $1 trillion coin possibility, because that would entail the Fed's acquiescence, at least, to that process. I think the Fed doesn't want quantitative tightening to be tied really in any way to the debt ceiling debate, but also not really to sort of the ongoing monetary policy conversation. They've always sort of kept this sort of at a higher level. Balance sheet maintenance, they see as more of almost a secular issue as opposed to cyclical. They want rate cuts to be the focus, but there's no question that they have a window between stopping the rate cuts, which we think is going to be sometime later this spring, and stopping the rate hikes and starting the rate cuts. And that's the logical time to end QT. So that may come sooner than later, especially if we're kind of hit with that debt ceiling debate right in the middle of the summer.
Brian, Nick, very quickly here, what does a 10-year real yield do? The inflation-adjusted yield, so important to finance. What's it do this year?
So I think you have a combination of continued disinflation, but that's largely been already priced into the TIPS market. So if things stay as they are, we see nominal rates falling somewhat, which would be a somewhat lower real 10-year rate as markets are looking forward into a period of rate cuts in 24, as opposed to a mix of rate hikes, pauses, and then eventually rate hikes in rate cuts in 2023. So I think we end the year lower, but not a lot lower, because we don't see that economic collapse recession scenario.
Brian, Nick, thank you so much. I learned a lot there. With Nuveen, of course, venerable in muni bonds as well. Lisa, what's so important there to me is the idea that we're hearing from Mark McCormick at TD and from Mr. Nick at Nuveen. It's just real simple. Is maybe the path boredom, where everybody gets to calm down instead of the ginormous, not carnage, but the ginormous volatilities that we saw, set of volatilities that we saw in 2022.
Yeah, some people saying that even if some of the bond yields that are really settling out at a higher level than they were a year ago, even if they just settle out, that would be enough for people to go back to capital markets to raise money, to invest, to have conviction. That volatility in the benchmark bond yields really causing some of the turmoil in risk assets last year. I want to just point out one thing. 3M, we were talking about how they had disappointing earnings and how they were going to be doing cost cutting. They say they plan to cut about 2,500 manufacturing jobs. So again, it's spreading on the margins away from just technology companies to also, real industrial behemoths that have to rationalize their size in a new era.
A real benchmark, David Rosenberg out of Toronto writing. He looks at leading economic indicators, which we saw. David Rosenberg saying recession, quote, is a lock.
Well, and this is what we heard early from Drew Mattis. The question is it really priced in a lot of stocks?
And I would go to something that we don't talk enough about, is what kind of recession is it?
Yeah, that's fair.
I would suggest it's a recession for a large but finite part of America, and there's a whole part of America that will just slip by, as they always do. John Farrow in conversation with Calum Pickering. This is Must Watch, Must Listen with Berenberg in London next. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. Poland has formally requested Germany's permission to send its German-made Leopard tanks to Ukraine. This comes after weeks of pressuring Germany's Chancellor Olaf Scholz to drop his cautious approach to delivering the tanks. German law requires approval for the re-export of military equipment. Bloomberg's learned the U.S. Justice Department is set to sue Google as early as today. The case has to do with the search giant's dominance over the digital advertising market. Google controls most of the technology used to buy, sell, and serve online advertising. The company has argued that the market is a crowded and competitive one. In the UK, there's more evidence that the economy probably has slipped into a recession. British companies signal that output has dropped at the fastest pace since the start of the pandemic. Meanwhile, the government's budget deficit rose to a record. Soaring interest rates have jacked up the cost of debt service. Verizon came out with a profit outlook that missed estimates. The largest U.S. wireless carrier's free phone promotions to lure customers are taking a toll on margins. Verizon has been losing market share to AT&T and T-Mobile. And Johnson & Johnson is forecasting stronger earnings for 2023 than expected. That comes after a year in which the pharma division was hurt by falling demand for its unpopular COVID vaccine. J&J will rely on other drugs this year to drive growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
inflation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnsons, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
Does this quickly become just a really crappy business model?
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We think China's reopening is good for China. It's going to be very good for the Chinese stock market. We're bullish there. But it's not going to necessarily drive revenue and earnings growth in the U.S. That's what I was saying earlier. You know, China basically is 3% of the S&P 500 revenues. So, you know, even if it is a faster reopening, it's not going to move the needle in the short term.
Mike Wilson, arguably strategist of the year last year in the equity space. He is with a shop called Morgan Stanley. There are the nuance, the distinctions of China in the United States. We're going to get to John Farrow right now, Lisa Bramwitz and Tom Keene in New York. But I want to make a note here of the world-class Bloomberg News crypto coverage. Emily Nicole is in London. Lisa, she's a religion major, which makes her perfect to cover crypto. It's just perfect. She has a story out, which I have no clue what she's writing about. It's about Binance, which I guess is the world of crypto now, and they're mixing collateral and funds of customers, including your kids, Lisa. They're in there somewhere. They're in that slot somewhere.
I think they're into the Roblox currency.
This is the adult pro view on crypto. I want to just draw that to everybody's attention.
The real issue is how far that really will go in terms of the fallout and the kinds of regulation or oversight of some of the collateral for people who are saying, and then for people who need to take their money out or want to take their money out of certain of these platforms.
We got a 23,000 print on Bitcoin, which means we can go to John Farrow. He is in London with the always interesting Callum Pickering. Mr. Farrow.
I actually have to start with an apology, Tom, just quickly. Taking a lot of heat for this from the last segment. Aluminium, okay? Just aluminium.
Yes, I did.
Not aluminum. Tom, I think we did it back to front. I think you did the English version, I did the American version. We spent too much time together. TK, thank you.
Yeah, sure.
Callum Pickering with me now, senior economist at Berenberg. Callum, I don't want to start with that. I want to start with this from BNP Paribas in the last 24 hours. I'll read the quote out for you and I'll get your view on it. Soft landing has been the catchphrase for still young 23, but we think it will go out the window in the same fashion as transitory inflation did in 2022. That line right there, do you agree?
Well, I think there are risks to this scenario. I think the danger is in markets we start pricing in, I would call it la-la land, which is we have two risks to worry about. There's the huge global energy price shock, which so far actually, at least in Europe and the US, doesn't seem to be playing out quite as aggressively as markets might have thought, say, 6 months ago. But then there's the reaction to that, which is tight financial conditions from central banks. Remember, this energy shock hit tight labor markets and tight product markets coming out of COVID and triggered these second round effects. And so the danger here is that we think, well, if the first risk is not so bad, central banks just cruise inflation to 2%, we don't really get anything severe when it comes to the recession and everything's going to be fine. History suggests central banks rarely get these kind of calls right. We already made a central bank mistake in 2021. The danger here is that we forget that central banks occasionally make these kind of mistakes and then land in a bit of a mess in the second half of the year.
What's the mistake potentially this year? Doing too little or doing too much?
I think probably doing too much is the bigger mistake. Monetary policy works with the lag, but the problem is once you've reacted late to inflationary pressure, it's very difficult as a central bank to justify pausing while you still have signs of inflation. And so a good example, take the latest mix of UK data, clear measures of economic activity weak through December and January, no question. But then you look at the November data for services inflation and December services inflation, you look at the wage data, and it's still edging up. Now, the economist in me says these price data reflect things that were happening in the economy 3 to 6 months ago. And so the prices 3 to 6 months from now will reflect these weak measures of activity. So central banks should indeed pause. Whether or not you can do that with inflation with a 9 handle or an 8 handle in the US.
Well, let's talk about the US situation. Tom mentioned it earlier this morning, 190,000 on jobless claims. What does that data tell you?
Well, again, labour market data react with a lag, underlying fundamentals. The reason why the Phillips curve was so appealing for a good 30 years as an economic policy model is because governments and central banks thought if we create some inflation, we'll have strong employment data. That still holds. We have a high inflationary environment. In nominal terms, economies are racing ahead. This gives us an illusion of strength, which encourages strong labor demand. I don't think we're heading here into a severe recession. I think business cycle dynamics are not late cycle. This is an early cycle economy. The Western world's an early cycle economy that's been intercepted by this big exogenous shock, and then central banks have reacted. But it's far too early to say that recessions won't happen as a general rule. I think actually all the pain is probably still to come.
What can you learn from corporate guidance? So we've got a couple of earnings reports this morning. I'll cherry pick two. D.R. Horton, as a home builder in the United States, purchase contracts the 3 months through December, down 38% from a year ago. I'll pick another one, 3M, job cuts, 2,500. I'm told there's a big China reopening. It's going to help manufacturing, industrials. There's one cutting jobs. What do you read into these right now?
Well, that seems to be the effect of the tight financial conditions on economies rather than the initial energy shock. And this is, again, where we just have to consider the lags that we're dealing with. The energy price shock, which actually for the US, the UK, and even in Europe, where we've managed to get enough supply now, it's really a terms of trade shock rather than a supply shock. We get the energy we need, we just pay more for it. We see that immediately. There's not much of a lag between the high price and the impact on economic activity. But there is a lag between what central banks do and economic activity. And so it's not inconceivable that there's very unusual window where the first shock isn't as bad as expected, things look fine, but then we're just waiting for the monetary shock to come through. That's why the housing market data and the labor market data are important, because those are major transmission mechanisms for monetary policy. And that's where I think we fall into this trap of thinking economies are fine, central banks need to go a little bit further to cool inflation, but in fact, actually, we've just made the opposite mistake to what we made in 2021, which was then to ease too much. Now the risk is we tighten too much.
So are we pricing in what you call la-la land relative to what you expect later this year?
I think the risk is that we start to price in this la-la land situation. I don't think it's inconceivable, but it's conditional upon certain things happening. And the main thing is that central banks don't make a mistake. And the other thing that we just need to keep in mind is we are out of the great moderation world, where inflation was trending to the downside and central banks could make a one-sided bet that you just stabilize growth and trust that inflation will remain low. We're now in an inflationary environment, aging populations, deglobalization, more fiscal activism, which means monetary policy is asymmetric in the opposite direction. We worry more about inflation risks than we worry about deflation risks. Or to put it another way, central banks now face a trade-off between growth and inflation. And remember, we wouldn't be worried about a recession now if central banks hadn't reacted. If we were happy to just accept the inflation risk from this oil and gas shock, then we would avoid a recession. But central banks say, actually, no, we're going to accept the growth risk. We'll put economies into recession to control inflation. And therefore, to the extent that this this gas shock is not hitting as hard as we thought because demand is stronger, that may mean that central banks say, well, if demand is stronger, we need to go further.
That's what we hear in Europe right now. Callum Pickering of Berenberg. Callum, it's more complicated than I think these markets let on in the early weeks of 2023. TK, are we pricing in la-la land relative to what some people expect later this year? That's one of the conversations we're having here in London.
John, Southampton, Newcastle, can you make it?
You had to squeeze that in, didn't you? Can we make that? Can we make that happen?
We can make it.
We can make it. Apparently we can make it.
Okay, good. Okay, take the surveillance, the car and fill it with petrol and, show up for Southampton, Newcastle.
It's gotten downgraded from the jet stream to the vehicle.
Well, no, but in London you've got to do that because everybody's on strike. John, the strikes are for real, right?
The strikes really are for real, Tom. To see the ambulance workers join in from yesterday. It's kind of shocking to go through that, Tom, and it's got the support right now, but I want to be clear about this. There are people who support this until something goes wrong and something happens personally to you and your family, and then you've got a very, very different opinion on those strikes taking place.
Yeah, Lisa, this is difficult on radio, but do you think Farrell's doing the Matt Miller beard? I mean, is this something he's going to come back and be
have
the bearded one?
I'm going to...
Well, let's get the camera up. Let me just, let me defend myself.
I'm going to say no way.
Just quickly. I get the feeling that Matt Miller paints his and colours his in.
He has a stylist doing that.
This is like stubble. I just get the feeling that he gets some paint in the morning and paints on a beard.
We have to give him time to defend himself.
He's got a stylist there. They're from Blitzer and Company. John Farrell, thank you so much. In London as well. We'll continue through interesting European activity through the week. Please stay with us. This is Bloomberg. Good morning.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance, Lisa Browitz and Tom Keene in New York, John Farrow in London. Futures, well, -7 earlier, and they're pretty much stasis here, -12 with the VIX 20.06 giving me nothing as well. What a conversation yesterday with Luke Tilley of Wilmington Trust with serious Philadelphia Fed credibility, working for the Philadelphia Fed with encyclopedic knowledge of the importance of Philadelphia to give us a diverse view of what businesses are doing. We're waiting here right now for the Philadelphia, it's a mouthful, Lisa, the Philadelphia Fed non-manufacturing activity index. I don't know if we're going to get this right here at 8:30, scheduled to come out, but it was a negative 17 number earlier, and we've seen some other tertiary regional data really be pretty grim recently.
How about the Empire manufacturing data that we got last week? That was pretty devastating, and this is the reason why some people are saying this is a recession. This is something that's really negative. You're not necessarily seeing that and how it's bleeding through into markets.
Why don't we move on for that? We don't have that statistic yet on the Bloomberg. We'll get it up. That sometimes happens with the regional data. S&P PMIs, we see at 9:45. I know John Farrell will have that from London with his good show coming up here in an hour. Right now, and well, you can pick this economist or that economist, this strategist or that strategist, but it helps to have a chief investment strategist and chief economist, this at Citi Global Wealth, who is truly expert at linking the earnings and profitability dynamics of American corporations into our greater American economy. Owning the high ground on that is Stephen Whiting, and he joins us right now. Stephen, I love in your research note how you say there are beats out there and there's a bang-up fourth quarter, but you're just not all on board the American recovery. How painful will those corporate earnings announcements be throughout the year?
Well, there's something to adjust to later. It looks so much in the analyst earnings estimates like the fourth quarter was the recession, and here we are sitting in the recovery. And it actually looks a little bit like that in financial markets. And it would be wonderful if that were really the truth, if we weren't just on the leading edge of the hit that we're going to have in profits. And of course, how markets traded last year are not anticipating this to be, some kind of profit nirvana. We don't have 20% declines, without something. But if you really take a look at the estimates, they fall at a 15% annualized rate in the quarter past. This is like setting a hurdle that a toddler could leap over. Most companies by far are going to beat those estimates, but then they're putting all that promise of the future that the year will be a growth year for EPS in the out quarters. But as soon as the second calendar quarter, the April through June quarter, there's a substantial gain. Now, there's some complexities. When you beat your earnings estimates, it's easier to hit those later numbers because of the level they come in. But the idea that this is all behind us in the economy, I don't think that's true at all.
Then how do you participate? I'm going to assume that Citi Global Wealth Management is not enjoying being 185% in cash like the triple leveraged all cash fund. How do you participate? How do you, if you're not all in cash?
Well, look, we've got to live with the ups and downs of equities markets, and we've had 3 rallies in excess of 10% since the Fed started tightening. The real rally, the turning point for the economy, the beginning of a new recovery is likely to begin this year. 2024 could be a stronger year for the economy. Do we think that we should already be discounting this recovery? No. So we are playing it safer. Again, our largest overweights are in firms that are the most consistent dividend growers, in pharmaceutical shares that have low cyclicality. I think this very near-term period, especially before we see the January employment report and we probably see the Fed deliver a hawkish 25, is probably going to be a period where we're going to have to settle back a bit. And again, that does not tell us to time the market and be all out of equities, but we're okay with a short covering rally and low quality shares and just missing that for the near term.
Stephen, how much would you lean into oil majors in particular because of that dividend story, that share buyback story, and not necessarily a call on commodity prices?
It's a full weighting despite a poor cyclical backdrop. I mean, we think that a lot of industrial and materials companies are going to see earnings downward revisions, are going to see weaker activity this year. I would say, though, that petroleum generally is pretty well positioned for a weak period for the world economy. The downside may be $70 in the Brent price in what will be probably a mild global recession or something that we might call that. Literally, the U.S. economy is going to have some significant job losses. We don't believe that you have sales declines without real job declines. We're not just talking about job openings. But even with that said, OPEC has cut production early. Supply sources around the world are recovering slowly. So I think this is not going to be a particularly bad cycle for energy.
Meanwhile, you mentioned the Fed, and we have been steering clear of the Fed because they are in the quiet period ahead of next week. But there is this question inherent in a strengthening financial conditions index, a lesser negative, actually a positive that Tom's been citing as you see the stocks rally and as you see bonds rally. At what point does this push the Fed to go further, to do more than people currently expect, simply because this really does kind of make it more difficult for them?
Well, look, I think the Fed can't entirely ignore the fact that real data, 2 months of decline in industrial production, 2 months of decline in retail sales, 2 months of a decline in total hours worked, and all of that survey data that you mentioned are softening. Plus, we are seeing a deceleration in inflation. That's for real here. We have a decline in money supply. Yet, the Fed is not going to be satisfied. And unfortunately, I think that is their mistake, as you heard from an earlier guest, that the reality is that there's still pipeline effects on the economy that are coming. The problem for markets is that they can't ignore the slowdown in the economy that will change the Fed's view. And the Fed is in all likelihood going to try to weigh against the easing in financial conditions. Will they do that by tightening more and harming the labor market even more? They probably won't, but they're going to leave it to markets to sort this out. And there can be certainly more corrections ahead simply because of that mismatch.
That's a critical distinction, Steve Whiting. If they're going to, quote unquote, leave markets to sort it out, at the end of the day, do markets tell the Fed what to do with its understood asymmetries?
When I think about the message at the long end of the bond market, the Treasury market is saying that the Fed is already at an unsustainable funds rate, particularly now that they shrank their balance sheet $450 billion. They'll continue to lend less to the bond market. That yield curve steepening that they predicted on QT didn't happen again. So I think that ultimately the Fed is going to get this forecast. But again, it is predicated on the notion that our labor markets, that demand for labor is going to fall now that we have sky-high inventories and massive declines in home sales to reckon with in terms of labor markets. So the Fed will get the message of markets. I believe the longer-term bond market is telling the Fed the right message. I just do think that they're going to say, like they said in the minutes, that if markets have misjudged their reaction function and they're going to ease here quickly, that's not what they're going to do. I wish they would pause, but they're not going to.
Right, and Lisa, you dovetail that with what Andrew Hollenhorst said the other day of, we go up 25, their new call from 50, et cetera, but then you get to a level, and to Mr. Whiting's comments, they stay there.
We're leaning into the long end because they do believe that it will restrict growth. They do believe that the Fed will induce something that's more significant. Stephen, how much are you using longer-term treasuries, longer-term sovereign debt as a ballast in a really uncertain time?
Well, we are. We're overweight long-term treasuries, underweight other markets like Japan, for example. Again, because we believe the correlation between stocks and long-term treasuries, equities and long-term treasuries, will break down and it'll be negatively correlated again. Portfolios will work with, barbells of high risk and low risk. At the same time, though, it's the front end of the curve and the belly of the curve that's offering real yield. So we have larger overweights there. And again, this is not to be negative in the long run. We can't be too cute about when markets can recover, but we're just not going to load up on a lot of cyclical risk. Interest rate risk, we think, is peaked in markets. So we don't have to worry about long bond yields going to 6 or 7. But we do think that there's a price to pay to keep 10-year Treasury notes at 3.5.
Stephen, before we let you go, do you care about the debt ceiling debate?
I think it's highly likely to be resolved. And I think that the debate over the House Speaker role, again, probably overstates the amount of risk There are multiple ways to address this. There are, again, some ways at which we can cause a disruptive period. Again, losing a House Speaker role, not preparing in advance sufficiently for this. So it can be a market concern. I doubt that it rises to 2011 levels of worry again.
Stephen Whiting, thank you so much. A complete analysis there, and particularly linking in earnings in corporate America into the greater American economy. He is with Citigroup as well. You know, Lisa, I look at this and it just simply comes down to the original time we're in, which is a pandemic. And as Drew Mattis was very good about, okay, pandemic in some ways, in clumsy ways, we're out of pandemic back to whatever normal is. I have no idea where we are in that continuum after listening to someone like Steve Whiting.
One thing that Stephen was talking about is the layoffs, and he thinks that they're going to be more deeper than a lot of people think that they're going to be. And we saw on the margins, it's spreading beyond big tech today. And I really do think that I do take a signal from 3M and what they're talking about on the margins. So the question is, are they going to maintain this as a marginal transition as they try to preserve most of their employees, or do you start to see some of the deeper cuts that Stephen was talking about?
I think it's simple. You go to the Bloomberg screen, you go DES, you figure out the head count, and you take a percent that you have. And anything within 2 or 3% is completely normal. 4% is where you begin the debate. And what we're seeing in tech, which is much higher percentages to a great extent, particularly among zombie-like non-profitable companies, that's maybe not what we're going to see in the 3M world, the Steve Whiting world, where maybe their percent will be a little bit lower.
Yeah, perhaps. But Julian Emanuel said, though, if you're seeing lower revenues, you can't cut your way out of that.
Yeah, that's where I am with disinflation. You get lower revenues. I think that's how it works. What I know is what it works is futures deteriorate negative 21 with a VIX elevated 20.19. Stay with us on radio, on television. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. New tensions between the U.S. and China. Bloomberg's learned the Biden administration has confronted Beijing over state-owned companies that may be helping Russia's war effort in Ukraine. The Biden team sees evidence of non-lethal aid being sent to the Kremlin. No one involved, though, is commenting. In Finland, the foreign minister says the government may need to reconsider whether to move jointly with Sweden toward membership in NATO. That's after Turkey's President Recep Tayyip Erdogan raised new objections to Sweden. Finnish Foreign Minister Pekka Haavisto says the primary option is for the two countries to join NATO together. In Germany, Bloomberg's learned the government expects Europe's economy to grow by 0.2 of a percentage point this year. That's instead of the contraction it had predicted in October. The updated forecast will be unveiled on Wednesday. In Half Moon Bay, California, police arrested the suspect in another mass shooting. 7 people were killed and 1 was wounded at 2 plant nurseries. The 67-year-old suspect was believed to have been a worker at one of the locations. Meanwhile, an 11th person has now died from the shooting at a dance hall in suburban Los Angeles. The suspect in that shooting killed himself. The CEO of Live Nation testifies today before a Senate committee about November's Taylor Swift ticket fiasco. Joe Berchtold will say the concert promoter learned valuable lessons when its Ticketmaster site crashed due to massive demand. The hearing will focus on competition in the live entertainment market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep rate while
This is a 3 as the economic picture does. The OK is getting ready to make.
To stress October 13th, Tom. The Dow had an intraday price swing of 1,502 points. Since that October low to the December 13th high, the Dow is up about 21%. The S&P is up about 18%. So there's been a nice recovery. And since then, the market's been consolidating. I think we're making a bottom long-term in this bull market.
On charts, the giant, Ralph Ancompora there was CMT co-founder. Just can't say enough about the decades of experience he has. And I was shocked, Lisa, how Mr. Ancompora didn't mince words. He just picked the bottom.
He is positive.
I did not expect that.
He sees it to be sustainable.
And there it is, clarity on the technical side. We'll move forward on that here in the coming weeks and days as well. This is really important. We need to get a briefing, and it was very important that we find a guest least qualified. If you go to Microsoft's website, they're out with their soiree today. They talk about cloud, computers, apps, and gaming. And we said, well, Mandeep Singh can't do this, but then there's ChatGPT. Using ChatGPT this evening and into the early morning to get up to speed here, Mandeep Singh joins us as well. Have you used ChatGPT? Have you actually looked at it?
I have, and look, it is great for certain kind of use cases when you're looking for, let's say, a code snippet or something which is plug and play, and it's great because it gives you a concise answer. You don't have to get to multiple links.
You have real-world experience. You're not an expert on Microsoft, and yet there they go, diving into ChatGPT. What will they do with it? What's the Mandeep Singh guesstimate of what they'll do?
Well, they are thinking of it as a feature that can be part of all their products, whether it's Office, whether it's their Bing search engine, which has always
Bing is still around.
It's still around, and it's making $3 billion a quarter. So guess what? If they can fix Bing and take share from Google, then ChatGPT.
This is the heart of the matter, Lisa. Bing, which is mother of all dogs, makes $3 billion a quarter.
It's because people who get personal computers, when they search it all, it automatically goes to Bing. So that's the reason why. Not necessarily because it's preferable to Google, but if they have ChatGPT, it could potentially boost that business. Does that give you a sense of where the revenues are going to be derived? Is it going to be in AI, in AI-driven types of industries, more than anything else for the tech companies you cover?
Yeah, look, I think for Microsoft, it's not just search. Also, their Office products can get smarter, you know? So that's where you're going to see AI come into the fold for all sorts of things. Every software company right now is thinking about how do I add that intelligence layer, which is analytics, but also it can make that experience a lot better. So I think overall, it's a good thing for the industry.
I can't talk about this without feeling really uneasy, I've got to be honest. As a mother of children who are in school, where there's a debate of whether to use ChatGPT and the teachers are trying to figure out how to get around it, and it's adjusting how they give tests and essays in colleges, you know, how much is there going to be pushback from this in a way that it disrupts the entire method of people evaluating each other and the use for humans?
I mean, look, even with social media, there are so many downsides of using social media, but we found a way to really make it viral, use it, integrate it in our day-to-day lives. I mean, we can argue whether it's for good or for bad, but there is an element of using social media. Same thing with ChatGPT. The fact that it can consume a lot of data, come up with intelligent answers, the processing power is used in a way where you couldn't do this before. And I think that's where you're going to uncover a lot of cases on the healthcare side. It could be huge in terms of processing large amount of data on the edge.
Well, that's with respect to software and hardware stories, but the technology of the Elon Musks of the world will be on full display on Wednesday. What are you expecting to see as the real world kind of comes to the fore, the revenge of the real economy that we've been talking about for so long?
Yeah, look, I think even for autonomous cars, if those have to become a reality, and there are a lot of doubters, and it will be, in a phased approach, but you can see the progress where we are going with this in terms of just making that car a lot more smarter, and that's where you're seeing a lot of custom chips. It can process real-time data. That's what I mean by processing at the edge. And a lot of companies have talked about it. The question is, how do you integrate it into a product that is used for a good purpose? Rather than plagiarism.
I don't want to embarrass you here with a private company, which I'm sure you're not up to speed on, but you are up to speed on Twitter, its culture rather, in the fabric of San Francisco. Lisa Mateo says they don't pay their rent, et cetera. There's no conference call, but where is Elon Musk 2 or 3 conference calls from now, say Labor Day of this year? Where is Twitter?
Well, I think Twitter right now is bleeding revenue. We saw, they lost almost 40% of their revenue. And that could be a good thing for the other digital ad companies that are also struggling. So right now we are going through that phase where ad pricing is down, and it's down a lot. And there is no hope because advertisers are pulling back. And you have Apple's privacy changes, that's hurting ad pricing. Well, guess what? Twitter is all brand ads. They have been bleeding market share, so that could be a positive for some.
He's getting very good. He didn't answer my question. Where is Elon Musk Labor Day with Twitter?
Well, I think
nobody knows.
Twitter
right?
needs somebody else to run the company. I don't know who that will be. He has to find somebody. He just can't manage both, and we're seeing that in the results so far.
We're talking about a host of different tech companies. Twitter, of course, is private, but Microsoft, Tesla, very much public, and we're going to get the earnings reports. What's baked in? How much pessimism, from your point of view, has been baked in, and how much are some of the layoffs, the cuts, the sort of rationalization really offset that?
Well, so estimates have come down mid-single digit for large tech, and I don't think it's pricing in that extreme scenario where second half is going to be disappointing. The consensus seems to be we'll have a second half recovery. Well, guess what? The fact that these companies are cutting now and they're cutting jobs and trying to preserve margins, that tells me it's not going to recover that quickly. But again, it will vary by sector, and we'll find out.
Do all these techie types find new jobs?
I think so, yes. I mean, given ChatGPT and all the other innovation on the auto side, these guys will be fine. Okay. They'll figure something out.
Mandeep Singh, thank you so much. Holistic there on all of technology, and I thought ChatGPT, he nailed Microsoft.
This is the big issue. How much can it really replace some of the search engines and make them that much more efficacious and create a real competitive kind of push against Google and the others? And, this is the upside of it. The downside is that your kids won't know how to write essays because they just use ChatGPT. Just saying.
The schools are going to have to adapt. I mean, I think it's going to be like in the colleges, and you're going to see it right down through the system of secondary education. They're going to adapt at light speed.
Well, they're trying to adapt already, asking more personal questions, although, as Mandeep noted, probably ChatGPT could nail your personality better than you could on any given day. But, whoa. Despite data that does indicate there's some sort of softening, which we did see, by the way, for the Philadelphia non-manufacturing segment. It did come in a little bit softer. Well, actually, it came in stronger, but it still did come in negative. But prices paid, just tanking for this particular metric, which really highlights the disinflationary push that people are talking about.
Well, there's a number of features out there today. There's a research paper, I believe it's out of Barcelona today, looking at instantaneous inflation. I don't have it in front of me. I'm sorry, folks. And they're saying we're there right now, 2%.
instantaneous inflation?
It's like
Is that
measuring
like instant
inflation at the moment. No, it's not like Tang. It's like measuring inflation at the moment.
Yeah.
Big debate in economics. Adam Posen, thank you for bringing that to my attention. But the bottom line is, a la Dominique Constant-Mazzuo, he's saying we're there right now.
What happens if you do have that disinflation, but the volatility where you have inflationary bursts that come up as the frictions are sort of sustained? How does, previously somnolent inflationary environment adjust to something that's a little bit more volatile?
Because I'm going to say this again, and this goes, do we have any Fed speakers today? Are we in quiet period?
It's quiet period ahead of the Fed
God
meeting.
For that.
Well, it's going to be all week, so.
Maybe we can have that all of 2023. But the point is that they're flying blind, they're flying original, and as Drew Mattis said today with MetLife, the idea here that we're coming out of a pandemic is this uncertainty that we're living with. No question about that.
We are readjusting to a new normal, but then it will be yet another new normal by next year, right? I mean, what does this mean?
2 days now, this Pharaoh in London thing, it sort of works, he's over there.
He's bringing us on the ground research.
On the ground research, and
Fulham.
I think he'll be here in a moment with a 9 o'clock show, and I'll be on radio with Paul Sweeney. Stay with us, futures deteriorate. -21, good morning.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Live from the City of London for our audience worldwide, I'm Jonathan Ferro. Equity futures down about 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Coming up, the S&P 500 closing above 4K for the first time this year. Investors choosing to ignore debt ceiling talks down in DC and preparing for Microsoft to kick off mega cap earnings. We begin with the big issue. Here comes Big Tech.
The big tech stocks. Big tech.
Today, the market is happy with tech stocks.
Microsoft seeing a nice bid to it. You're seeing Alphabet bouncing back here.
The rally, no doubt. Some of the tech names, have become a lot cheaper than they were.
But I'm not sure that that's going to continue.
The story this year is the earnings risk and the recession risk.
The economy rolls over into recession, and it's very unlikely stocks will hold up. That's not priced.
There's a borderline question of a soft landing in the US.
Listen, we're about to enter into an earnings recession.
You have had circumstances where there has been an earnings recession without that economic downturn.
We hope that the Fed will engineer a soft landing here in the U.S.
There is an opportunity for the Fed to perhaps orchestrate a soft landing.
Joining us now to discuss Academy's Peter Chair, Lisa Hornby of Schroders. Lisa, first to you. These are your words. The bear market in risk is not done. Why is that?
I think some of your guests earlier alluded to it. We think that this year is going to be about the growth downturn and the earnings downturn. And if it is, we don't think risk assets are properly pricing that in, especially at the moment. Credit has been on a remarkable tear the last couple of months. Our estimates suggest that investment grade and high yield credit are discounting around a 1 to 2% growth rate in the U.S. We think that's entirely too optimistic based on the leading economic indicators that we look at. And so
Pete, you
we
agree.
think there is some downside
Equities
risk
are up,
to come.
the Nasdaq's up, the S&P's up, Euro Stoxx 50's up. Lisa's talking about credit. It's not just credit, it's equities as well. I've got the Nasdaq 100 up by 8.5%. Peter Chair, a lot of people are wondering whether they should chase this, and you say, resist the urge to put dry powder to work. You agree with Lisa Hornby here?
Yeah, we've been fairly bullish coming into this. We thought people were going to mistake weaker data for this potential for soft landing. Everyone's hopeful the Fed's going to fix things. I think it's going to start really deteriorating, and we're going to hit this point where bad news becomes bad news again. And that's what I'm looking for, is weakness across the board in equities and risk assets.
Pete, how much bad news do you see right now? I mentioned jobless claims a few times this morning, 190,000. That seems to be the thing that's pushing back against that bearish narrative.
So I'm generally ignoring jobs, obviously with some risk on that, but I think jobs is always lagging, and it's going to be particularly lagging this time. We just went through a year and a half, 2 years where people had so much difficulty hiring people, they're not going to let them go soon. So I'm looking for other things. Last week, Wednesday, I believe, it was an awful day for me. You had retail sales go down, which is bad enough, but inventories kept building. It's the inventory build that we've seen in consumer goods that concerns me, and I think we're going to see a similar pattern in the services industry, where there was this huge demand pulled forward late summer, spring, fall, and into the holiday season, and I think that's going to drop off as well. So that's where I see the problems.
Soft landing is the new transitory, seems to be the theme over at BNP Paribas. Carl Riccadonna leading this effort, him and the team writing the following over at BNP. Soft landing has been the catchphrase of a still young 2023, but we think it will go out the window in the same fashion as transitory inflation did in 2022. Lisa Hornby, I'd love to get your view on that. Your view particularly. Do you agree with that?
Yeah, I think there's some merit to that. I mean, look, we look at the consumer data in a lot of detail, and consumer spending has been held up over the last couple of years because of a tremendous amount of fiscal transfers, because savings rates have been relatively high. But we think that the consumer is more challenged heading into 2023. We've seen a lot of that savings been drawn down. We now look at active savings, the actual savings rate at this point in time at basically historical lows. The only time it was worse than this was in 2005. We just see, with negative real income growth continuing, at least for the foreseeable future, we just think it's going to be hard to maintain that same level of consumption. And case in point, we have seen credit card expansion. So revolving credit is expanded by about 15%, which means that consumers are in fact tapping into debt in order to continue to fund their payments. That's not a perpetual, that's not something they can do forever. That's temporary. And we think that's where things start to get weighed upon. I would completely agree with Peter on the job side of the equation. That does tend to be a lagging indicator at best. And so what we would expect to see is we'd expect to see some softening on the consumption side, and then eventually that turns into job losses. It's slow going for sure, but that's actually typically how it is at this point in the cycle.
Pete, is soft landing the new transitory?
Yeah, I think it's going to disappear. And I did steal this, I think, from Tom Keene months ago, this idea of a pendulum. And we started at this really good point. And if you take a snapshot, it looks okay right now. It's going to swing all the way through. I think we're going to have a hard landing. It's going to be longer. And I think the epicenter of this is going to be around big tech, semiconductor businesses. Kind of the latest phrase that we're talking about is that tech took 5 steps forward post-COVID, and it's going to take 2 steps back. Everyone's rethinking. There's some spending curtailing going through that. So that's going to be the epicenter of the problem. It's going to flow from there.
Pete, can we just sit on big tech a little while longer? I went through the numbers yesterday. Let's do them again. Microsoft cutting 5% of the workforce. Looking at Alphabet doing 6%, Salesforce doing 10%, Meta doing 13%, and maybe still more to come. Pete, why do you think that is a big story? Because a lot of people might look at that and just say it's one industry. There was a ton of excess in the last 2-3 years. That's going to unwind. This isn't the big, broader economic story you think it is.
So I would push back that if you look at the disruptive companies, the employees of the disruptive companies, anything that private equity is investing in, right, where there was this ability to raise money and your whole goal was to spend that money as quickly as possible so you could move on to the next raise at a higher valuation, that's all gone. So all their customers, I think, are under a lot more pressure. I think companies are rethinking their push to big data, how they're going to use AI. So everyone's a little bit holding back. So I think this is just the starting point of this. And then on top of that, there's clearly friction going on with China at the high end of chips, but whether that feeds into the low end of chips, what goes on there, I don't want to call it, World War 3.1, but there is a real friction between the U.S. and China on high-tech chips, and that's filtering the way through the system. So there's a lot that is not yet being felt in this market, I believe.
Microsoft results coming a little bit later after the bow. We'll catch up with Ed Ludlow at around 9:30 Eastern Time, so about 24 minutes from now. Corporate earnings across the board this morning, interesting. Continuing to tighten the belt seems to be the theme over in corporate America. 3M joining the growing list of companies cutting jobs. 2,500 to go. The CEO, Mike Roman, saying this: a necessary decision to align with adjusted production volumes. We expect macroeconomic challenges to persist in 2023. Katie Lyons has more. Hey, Katie.
Hey, John, this is becoming a literal daily occurrence, me coming on here and talking about a new company announcing job cuts. Those 2,500 job cuts from 3M you mentioned are specifically in manufacturing, and they are global as the company is contending with weakening demand in many of its segments. And the company doesn't expect that to get all that much better in the near term. Its guidance came up short of expectations, which is why the stock is down the better part of 5% before the bell. They missed on the guidance for the top line and the bottom line, and importantly, margins also were expected to be tighter than what the street was projecting. So that's where the cost cutting comes in. They are trying to retain more profit, hence your Tuesday layoff news, which of course follows a Monday in which we had more layoff news. Ford cutting about 3,200 jobs across Europe, or planning to, after they already eliminated 3,000 jobs primarily in the U.S. last year. Then you had Spotify's announcement yesterday that it was laying off 6% of its workforce. Before that, Apple, Microsoft, Amazon, Salesforce, Meta, Twitter, which you mentioned, a wave of job cuts across the technology sector in particular. Nearly 100,000 were announced over the course of 2022. We've had tens of thousands more already just in the month of January, the first month of this year. And of course, they're starting to hit the financial sector as well. Goldman Sachs, one of the primary examples of that. And what all of those companies I just mentioned have in common, John, is something you were just alluding to. They built up their headcount substantially over the last several years, and now that the economy is softening, they're having to cut back.
Katie Lyons, thank you. We'll pick up on that story again in about 20 minutes. Looking forward to catching up with Andrew Sliman of Morgan Stanley. Just taking a look at the market right now, going into the opening bell, 22 minutes away. Equities down by 0.5% on the S&P. On the Nasdaq 100, down 0.7%. I think this week alone, a quarter of the S&P 500 reporting earnings. If we take a snapshot of the bond market, 2s, 10s, and 30s, yields lower over the last 3 or 4 months. Back in October, the 10-year topped out at about 433, 434. Right now, about 351. The 2-year topped out close to 480, right now about 423. Lisa Hornby, yields lower the theme since the October highs, or at least the highs of the last 6 months or so. Lisa, can you help me answer this? I wrote this one down because I was really thinking about it yesterday evening. Are we pricing in cuts because we think there will be a soft landing that doesn't require high rates? Or are we pricing in cuts because we think there's going to be a hard landing that requires loose policy? Which one is it?
I think that is a great question, and that is sort of the inconsistency that we've been highlighting in the market, right? The market thinks we're going to get to this point that risk doesn't deteriorate enough, the economic data doesn't deteriorate enough to actually impact risk markets, but the Fed is still cutting rates. So I think the market is discounting some of a Goldilocks scenario, right? Things slow quite gradually. Inflation has come down by just enough to not actually impact consumer demand very much. And therefore, the Fed can loosen policy a little bit and we're kind of off to the races. I think that's a really optimistic scenario. And not only is it optimistic, historically, it's basically unprecedented, especially when you have the tightest or most aggressive hiking cycle that we've had in 40 years. So I think there is a bit of an inconsistency here. The yield curve, which is an indicator that has historically worked very well, is telling you with the curve as inverted as it is, a recession is likely. It is imminent. There's somewhat of a lead time between the curve inverting and actually getting the recession. So it could be anywhere between the next, let's say, 6 and 12 months. But I think it is coming. And I suspect the market will move on to that narrative in the coming, let's say, 6 weeks to 3 months period.
The 2-year, 10-year curve right now, negative 72 basis points. Peter Cheer, how much signal's there?
I think there's been a lot of signal in that. The one thing that I've been watching is Waller came out on Friday saying he's comfortable doing QT regardless of what they're doing with rate hikes or cuts. And I think that's going to be really important. To me, QT weighs on the markets. I think treating rate hikes, rate cuts, and QE and QT similar, it's just wrong, right? I think it's like salt and pepper. They both make your food taste better, but you've got to be careful. They behave very differently. So I think we've got to start preparing for a world where we have QT for a year, 2, 3 years. And I think that is going to be a weight on risk assets. It tends to directly affect risk assets. I think the Fed's trying to use that to steepen the yield curve, take some of those signaling noises away. I think that's going to fail. I think what it's going to do is keep a lid on stocks and high yield and junk bonds and the riskiest assets from performing very well.
Pete, when you hear long and variable lags, do you also hear just a fancy, sophisticated, educated way of saying, we've got no idea?
I keep having this image that they've pushed the economy over the cliff, and instead of just watching it, they're pushing it further down. It's already falling. It's already heading down. They should be worrying about trying to catch it, making sure there is the soft landing, and they're still pushing. I think it's ensuring that we have this hard landing, and if it wasn't for the ghost of the past, had they not missed transitory so badly, I think we'd be having a much different discussion, and that's one of the problems. I think it's almost like a stop-loss situation as a trader. You've made mistakes, so you're not thinking clearly. I think that's where we are at the Fed. They should have been watching this and preparing for a soft landing 2, 3 months ago. The fact they didn't is why I think we're going to have such a hard landing.
They're scarred by 21 and conditioned by the 1970s. Lisa, do you agree?
I think there's some of that. I think the other point that we haven't touched on yet is that financial conditions are still easing or are materially easing. They're actually back in positive territory now. And, the central bankers back in December, and I think Powell was at the forefront of this, spoke about the risk of unwarranted loosening in financial conditions. And I think, unfortunately, the reality is that if financial conditions loosens, it actually makes their job more challenging, and they actually have to end up being more aggressive or speaking more hawkishly than perhaps they otherwise would. And I think that's part of what we're going to hear next week when Powell speaks. Is I think he's going to push back on this idea that the market is pricing in rate cuts. I think he wants to telegraph the narrative that, hey, look, we are going to get to perhaps 5%, and we're going to stay there for a while and see what happens. We're not in any rush to start, to start cutting rates.
Lisa, just one more question from me on how you think about the way this works. I just want to read a line from Vice Chair Brainerd's speech from last week, and she talked about the long and variable lag. She said this: "It is likely the full effect on demand, employment, and inflation of the cumulative tightening that is in the pipeline still lies ahead." Lisa, with that in mind, how much of the recent easing undoes some of the cumulative tightening of the last 12 months?
I think it undoes a good amount of it. I mean, look, capital is still not free. At the end of the day, the cost of capital is much, much higher than it was 6 or 12 months ago. And I think that's the long and variable lags, right? We know that this will impact investment decisions for the foreseeable future. But at the same time, you have undone some degree of that, right? Because at this point now, the market is not only looking through the rest of the hiking cycle, but predicting some rate cuts in the back half of this year and then early into next year. And so that undoes some of that impact. And, we're actually seeing it in mortgage rates. Mortgage rates, right, have come off their highs. I think they were north of 7% at one point towards the end of last year. And now they're back in the 6% range. Still tight, but not as tight as they were before. Still having an impact, but perhaps not as much as it was before. And I think that's the point. inflation is coming down, that's quite clear, but I think it might be hard for them to get inflation from, let's say, 6% where it is now. From 6 to 4 will be easy, but from 4 to 2 might be more of a challenge. And I think that they are certainly worried about that. I think they're worried about the playbook that happened back in the late 70s, early 80s, where they were too easy to cut. And then they had to go back and reassert themselves in a much more aggressive program. And that's where it comes back to the, citing Volcker and the learning the lessons of the past.
I keep thinking back to that line from Sarah House of Wells Fargo, the last mile from 4% down to 2 is going to be the toughest mile. Lisa Hornby, Peter Cheer, two bearish views on this panel right here. They're going to stick with us. Coming up, debt ceiling talks, picking back up in DC.
Brinksmanship, hostage-taking, default on the debt should be off the table. At stake is the health of our economy and the very stability of the global financial system.
That conversation up next.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now, we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Frankly, I expect the House Republicans themselves will struggle to come up with a serious answer. Because deep down they know that no matter what they propose, their cuts are likely to be deeply unpopular with the American people. Brinksmanship, hostage-taking, default on the debt should be off the table. Both parties should work together to ensure we can continue to pay our debt on time. And we Democrats are ready to move quickly in order to make that happen.
The House back in session amid simmering tensions over the debt ceiling. The Democrats on the one side pushing to raise it, the Republicans on the other determined to secure spending cuts, and the White House refusing to negotiate. This as President Biden prepares to meet with top Democrats this afternoon. Down in D.C. now, Bloomberg's Anne-Marie. AMH, what's on the table today?
Well, today, Jonathan, he's just meeting with the top congressional Democrats. So likely they're going to discuss a number of issues, this being one that is right in the forefront and center of what's going on in Congress right now. But they do have some time. But Don't expect anyone coming out of this meeting on the Democratic side saying that they've agreed to any sort of spending cuts. So the real meeting that we're waiting for, this is the meeting before the meeting, is when he sits down with Speaker McCarthy. The White House had put out a statement saying that the president looks forward to sitting down with Speaker McCarthy and that they will discuss economic issues like the debt ceiling, but they said in that statement that they will not negotiate when it comes to raising the debt ceiling for spending cuts. But Jonathan, we're still waiting on a date when the president will sit down with the speaker.
The X date is the date we all want to know. When do we actually hit the wall? Anne-Marie down in Washington, great work as always. The fiscal debate shaping up on Wall Street, investors weighing in on whether to buy or sell treasuries should the US default on its debt. JP Morgan's Ian Steely expecting treasuries to rally, following in the footsteps of 2011. State Street taking the other side of this. I'd be much more inclined to believe that treasuries would do the opposite if that were to happen again. Peter Cheer and Lisa Hornby back with us. Lisa, I think this is the stress test over any debate going into this debt ceiling debacle later this year. If things hit the fan, would you buy or sell US government bonds?
You know, it's a good question. Obviously, in the 2011 scenario, long bonds rallied materially with the debt ceiling standoff that happened at that point. You know, I think markets might look at it and say there's actually alternatives, high quality alternatives that you can own that don't have the risk associated with this. Reality for me, likely something gets done. If there is a technical default scenario, it's going to be fairly short-lived. I think investors have written into their guidelines what to do in the event that there's a short default window with regards to treasuries, where people are not forced sellers anymore the way they might have been pre-2011. So I think that there are some provisions. Obviously, it'll be a very volatile experience, but I think it'll be volatile for a short period of time. What I would do is avoid the treasury bills that are maturing around the X date. Right now, we think that's probably sometime around the midsummer point. It could be a bit earlier if tax receipts perhaps come in a little bit lower in April. We should get some guidance, or around that point from the Treasury Department. But the experience of the past has been avoid the Treasury bills with maturities around that date. So push them out as far as you can, and let's just hope that the government can come to an agreement on this.
And that's the hope. That's the expectation for most people on Wall Street anyway. Peter Cheer, I want to finish with you on all of this. Do you think 2011 is the right comparison?
No, I really don't. And I think even the past few years, I've had a pretty simple approach to debt ceiling debates. It's like you sit there, you watch, both sides make noise, and then both sides will get more money than they wanted, and they'll move forward. I think this time could be really different. I think we're seeing real friction at the political level and beyond. And I think I want to play this by starting to avoid the dollar. I think the dollar weakness which has started a little bit, would continue, right? People aren't going to trust the dollar if this happens. So I think this time it's much worse, much more dangerous, and it feels like it's more than just political posturing. I guess that it could happen this summer. My understanding is there's probably things that the Treasury Department can do that pushes it off later. But I think this year it's actually going to be an issue for markets, which is kind of annoying because normally it's so easy to ignore. But this feels very different. Remember, we just went through this potentially very bizarre process of getting a new speaker. That was unusual. Yep. I don't see any reason that doesn't continue into this debt ceiling debate, and that's problematic to me for risk.
Well, Peter, got 30 seconds. You said avoid the dollar. Does that extend to the Treasury market beyond the T-bills that fall around the X date?
That one, it's tricky. I would say yes. I'd probably start lightening up on treasuries because, again, you've already seen now in Japan, right? You can actually get yields in Japan. So I think Japanese buyers who've been loving buying dollar-denominated paper and asset swapping it out to hedge out the FX risk will stop doing that. You stop seeing that in Europe. So I think it's less and less foreign demand for dollar-denominated assets is going to be a problem. And that's treasuries and stocks.
Fantastic. Fantastic and very, very interesting to hear you on that side of things, because right now, that's still slightly contrarian. Lisa Hornby, my thanks to you as well over the last 30 minutes or so. Coming up on the programme, the morning calls and later, big tech earnings kicking off with Microsoft after the closing bell. Morgan Stanley's Andrew Sliman weighing in, plus making a case for buying the home builders. That conversation, that's 7 minutes away.
did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Minutes away from the opening. Dow equities negative here, down 0.5%. Let's get you the morning calls. First up, Bernstein downgrading AMD to market perform, seeing limited upside due to the competitive PC market. Your second call from KeyBank, upgrading Lyft to overweight, saying recent checks indicate the company's turning a corner. That stock up by 3.8%. And finally, Towsey cutting his Amazon price target down to 125, expecting the spending environment to become more challenging. There are three of your calls coming up next. The rally in big tech facing a big stretch of earnings. Microsoft up next.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
massive earnings week coming right up. 25% of the S&P 500 reporting. It all kicks off big time with Microsoft after the close. Going into the opening bell, equity futures negative 0.5% on the S&P. The Nasdaq down 0.6%. The Nasdaq 100 year to date absolutely flying. We'll pick up on that in a moment. There's your opening bell. Switch at the board and get to the bond market. Yields look a little something like this on a 10-year. Your 10-year yield doing nothing at 350.97. Some important PMI data coming up in about 15 minutes. We'll break that down with Mike McKee. Euro dollar 108.63. The composite PMI out of the Eurozone above 50 for the first time in expansionary territory going back to June. Euro dollar still negative by about 0.1% on the day, and just to round things out for you, crude just short of 82, but positive about 0.1% or so. The opening bell then, we're a little bit lower, about 20 seconds into this. We are down by 0.5% on the S&P 500. On the Nasdaq, we're down about 0.5%. Also, one stock to watch at the open is 3M, delivering a downbeat outlook and announcing plans to reduce its workforce. The CEO, Mike Roman, saying the following: "We expect macroeconomic challenges to persist in 2023. We will reduce approximately 2,500 global manufacturing roles, a necessary decision to align with adjusted production volumes." Abby has more on the story. Hey, Abby.
Hey, John. Well, yes, a rough morning for 3M, and indeed having its worst day right now since 2022, August of 2022. What's really interesting, we have a lot of circuit breaker issues at the NYSE right now, it appears, based on my breaking news, my news headline. And this stock on the open at one point down 16%, its worst day since 1987. I don't know if that'll hold, but yes, a bad day, a bad year, and a bad 5 years for 3M. You and Kaylee earlier were talking about the layoffs, 2,500 manufacturing jobs cut. That is certainly a piece of it, but it also has to do with the earnings miss. A messy quarter, really. Sales basically in line, and then, of course, that weak outlook, also a piece of what's going on. The CEO mentioning those macro headwinds. Now, this company, of course, makes everything from Post-it notes to surgical supplies. Healthcare is the only segment, though, John, that is growing. Healthcare growing by 20%. Consumer, safety, industrial, transportation, electronic, all down. So net, we are looking at 2% growth. Not great for this conglomerate. Meanwhile, the company is facing liabilities all over the board relative to their military earplugs, plus on a carcinogenic fire foam. So over the last roughly 4 years, this stock down about 44%. Over the last 5 years, down about 50%. Really underperforming, as you can see, the industrial sector, which is up close to 50%. So 3M's woes continue. It doesn't really seem like there's a bright spot for this stock at all right now, John.
That stock getting absolutely hammered. Abby, thank you. Let's stick with earnings. Some mixed results from the home builder, D.R. Horton, this morning. The home builder topping estimates as the C-suite delivers a warning on the challenging environment, saying the following: "We've seen a moderation in housing demand caused by significant increases in mortgage interest rates and general economic uncertainty." Kelly Lights has more. Hey, Kelly.
Hey, John. Yeah, they did manage to deliver that beat on the bottom line, which is likely why we see the stock up about 2.3% at the opening bell. But just to put that profit into context, it's down about 41% sequentially from the prior quarter and down 13% year on year. So yes, a beat, but we still have to keep that in mind. And where you're really seeing the pain in the housing sector showing up is in their purchase contracts. Those were down about 38% from a year earlier, so those quarterly orders actually missed expectations. And on the call, executives did warn those pressures may persist. They said expect revenues to drop in 2023, along with prices and gross margin, because they are still offering incentives to drive buyer traffic. Those incentives, like price cuts and mortgage rate buydowns, do come at a cost and weigh down margins. The company's gross margin on home sales fell to 17.5%, down from 21.2% a year earlier. But if there is a bright side to look at, John, it's that mortgage rates aren't as high as they were. The average 30-year rate has fallen from 7.4% back in November to just about 6.5% net now, and that has led to improved home builder sentiment as well. It actually rose this month for the first time since the end of 2021, and that has improved sentiment in home building stocks. By extension, that Spider S&P Home Builders ETF, which is what we're looking at here, has started off 2023 strong, up about 9% in January so far, which does put it on pace for the second best month in about 2 years, John.
Kelly Lights, thank you. The stock up by about 1.9%. Microsoft, the big one after the close. Guggenheim giving the stock its first sell rating in more than 3 years going into the print, saying this: "Well, most investors see Microsoft as a large, stable business that can weather any storm. It does have vulnerabilities, some of which could be exacerbated by this macro slowdown." Ed Ludlow, that in the last couple of weeks ahead of earnings after the close.
Yeah, Microsoft is what we're bracing for because they're the first mega cap up. Fourth quarter earnings for information technology stocks on the S&P 500 forecast to drop by 9%-ish from the same period a year ago, but that would be the steepest decline in profit or earnings since 2016. You know, Microsoft's top line growth at least was kind of the poster child of the pandemic era, but if we bring up this terminal chart, this is going to be the first quarterly top line growth that's sub 10% for a really considerable period of time, going back 22 quarters. So there is the one question, right, which you posed at the top, moving from the pandemic era of growth to a recessionary environment, how is Microsoft set to fare? We know they laid off 10,000 workers last week and that they'll book a $1.2 billion charge. As a result of that, that translates to a 12-cent hit to EPS when we consider the bottom line. That Guggenheim call, really interesting. It downgraded from sell to neutral on January 17th. It was the first sell rating on the stock going back 3 years. But this is just the start, John, of what I'm expecting to be a very long earnings season. And again, go back to your open, how does Microsoft fare in this environment relative to others? That's, I guess, the question and the benefit of going first this earnings season.
The mega cap tech results start after the close. Ed, looking forward to your coverage over the next couple of weeks, that's for sure. Morgan Stanley's Andrew Sliman looking for investments that could outperform in any earnings environment. He writes the following: if we have a recession, earnings are too high, soft landing, and earnings might be too low. It's a binary outcome. He goes on to say, so we like the areas already pricing in a recession and where central banks aren't tightening. We like the home builders and China. Andrew, I'm pleased to say, joins us right now. Andrew, buddy, good to catch up. Let's start there. The home builders. The home builders, why?
Well, look, you just mentioned it. Not a very good quarter and the stock's up. Why? Because they got decimated last year. These stocks are early cycle stocks. They're telling you that mortgage rates are going to come down in the future. So even though it wasn't a great quarter, this is why the stocks are up. So when you think broadly about the stock market in general, I just think you want to find companies that already reflect, not a great earnings season for 2023.
Well, we mentioned D.R. Horton. That actually bottomed last summer, I think, in June, and the stock's up 50% since then. Is that a decent name, or are there better names out there?
Well, yeah, I think that's a very fair point. I would look beyond the initial home builders to some of the home furnishing stocks, because don't forget, consumer discretionary as a sector was down 37% last year. Consumer sentiment, according to the University of Michigan, hit an all-time low. And I think you want to move beyond. Well, if the home builders have started to recover, maybe that means home furnishing, home apparel, anything home related that aren't up nearly as much. Those are opportunities I would look to, especially because they fall in that consumer discretionary group.
Andrew, can I just ask, who's going to be buying these houses? There's going to be a whole generation of people locked into 3% interest rates. They're not moving anytime soon. Where does that demand come from?
Well, rents. Look at rental income. I mean, rents are sky high right now. Now, the other thing to keep in mind is, yes, housing's turned down, but because new housing starts weren't able to be completed last year because of a lack of supply, there's not this huge glut of houses already built like we saw in 2008. So I think it's a very different situation. But again, remember, you have to think about what does these stock prices reflect, and I think it's a lot of negativity right now.
You mentioned China and China reopening. Europe certainly grabbing hold of that story and running with it. European equities on the Stoxx 50 close to up 10% year to date. The other question I have really is not what's happening in Europe and China. It's what's happening in the United States. I hear a lot of people say buy international, avoid the United States. It's too exposed to tech. Tech is absolutely ripping, actually almost keeping up with what's happened with European equities, Andrew. Why is tech running so hard?
Well, I think, again, it is a case of it got decimated last year. Look, there's no question in my mind earnings aren't going to come in great. But the key question is how much of that is already priced in from last year. A great little statistic, Jonathan. The last 11 times we've had a down earnings year for the S&P, the market was up 9 times, right? 9 times. So all that implies is stocks already reflected a down earnings year. This is why I think the NASDAQ is ripping. Now, I've got to say, short term, be careful. because anytime you have a situation where the NASDAQ is ripping, going into earnings season, that's a dangerous scenario.
Andrew, I'm going through some of the cuts. We talked about them earlier with Peter Chia of Academy, just some of the job cuts out there at the moment in that sector. Some of it's brutal. Meta, 13% of the workforce, Salesforce, 10%, Alphabet, 6%, Microsoft, 5%. When you see that, clearly that's bad news for the people on the wrong end of it. For the stock specifically, Andrew, is that good news? Does that make a material difference?
I was shocked after third quarter earning, when I listened to the third quarter earnings season in October, how these companies were very, they didn't seem to understand the downturn in the economy. And I think they're coming to realize in a quick fashion, and I think this is one of the reasons why these stocks got hammered in the fourth quarter, and they're coming back because management is proving that they are willing to pivot off this perpetual growth, reign they've really been in for, over a decade.
We've had the valuation challenge. Fed funds has gone from 0 through 4. I get that. Have we seen the earnings challenge? Yeah, Andrew, for some of these big names. I want to go back to that quote from Guggenheim. That first bearish call in something like 2-3 years on one single name, it was Microsoft, who said the following. This is Guggenheim. Most investors see Microsoft as a large, stable business that can weather any storm. It does have vulnerabilities, some of which could be exacerbated by this macro slowdown. We've seen the rates challenge. Have we seen the earnings challenge yet? Are we priced for that?
Yeah, I mean, those comments would strike me as perfect for what I heard out of third quarter earnings report last year. Are they, but now they're recognizing that they can't weather the storm, and they're making cuts to businesses that were less profitable. So I think the setup is actually, not bad going into earnings season because expectations are very, very low. So again, I just go back to these companies are pivoting and they're telling you, hey, no, we recognize we need to make adjustments to our business, and I think the market likes that.
So if I gave you a choice right now, just a final question, a choice between the cap-weighted S&P 500 or the Euro Stoxx 50, which one would you choose to hold for the next 12 months?
Well, the problem with the cap-weighted is I think many of these big companies are coming under the thumb of the U.S. government that's going to slow their ability to make acquisitions and grow. That is a bigger story than earnings, which is, the Department of Justice is looking into these companies. And that, when you look back in history, that's always what brings down the biggest companies, that slows, they're knocked off their pedestal as the largest company. So I wouldn't bet on the S&P cap-weighted versus European index. I might bet on equal-weighted, but I'm not sure cap-weighted.
Andrew Sliman on the latest. Thank you, Andrew. I want to head back to Abby just on that breaking news around the opening bell. Abby, let's go back there. What's happening to some of these halted stocks?
Yeah, it's really interesting, John, because that news came out and it was very different from what we usually see on the tape at that time. But stock after stock after stock, basically most NYSE stocks were paused for volatility. And as I had mentioned earlier on 3M, it showed a print of being down 16% in the first minute or so. So that suggests that there was some wild trading. But stock after stock from Nike, basically Occidental, they're all resuming now. So basically overall, NYSE has said that the trading, that they're open, that they've seen an unusual number of halted stocks. And on J&J, it's interesting because this stock in the pre-market had been up, it had been down, and now right around the time of the open, our internal Bloomberg system showed that it had been down for some range. Now it's showing that it had been up as much as 4%, and currently it's hard for me to actually even tell how much the stock is up. It looks like it's up just slightly at this point. And they, of course, put up a little bit of a disappointing quarter. They boosted their full-year earnings outlook. A bit of a surprise, John, of course, given the concern over the future of their COVID shot. The drug unit sales rose by 2.3% last year, but were up 4.3% without that COVID drug. The Street, their guidance had been for 2.4% or 2.4 billion or so. The range is above. Consumer health, the least contributing to the overall outlook. Pharmaceutical was the best in the fourth quarter, more than 50% of revenues. But again, this NYSE trading situation, we'll be watching it all day. It's really pretty interesting. It's also interesting, John, because you have been talking about this rally all morning. This stock, Johnson & Johnson, healthcare, those stocks are all down this year.
Abby, thank you. On the latest, on the breaking news and what's happening with J&J as well. The broader equity market, for what it's worth, for 15 minutes into the session, we're down about 0.5%. Coming up on the programme, another dose of optimism for the Eurozone.
We're seeing upside surprises in the data. This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected.
That conversation up next.
Breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Names in global leadership are on Bloomberg.
I very much support the idea of a stronger sovereign geopolitical European Union. Democracies should cooperate, and that they should understand that there is something we have in common: respect for the individual rights of men, being in favor of the rule of law.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
We're seeing upside surprises in the data. This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected. And so I think there's a very good case for Europe to at least outperform some of those really downbeat expectations.
Let's get you some breaking news. We can get that with Mike McKee right now. Hey, Mike.
Hello, Eric Robertson was right about upside surprises. We get that in the S&P PMI indexes for the United States, which just crossed, with global manufacturing coming in at 46.8, up from 46.2. The services index 46.6 from 44.7, and the composite index 46.6 from 45. So it looks like an upside move on all counts, except for the fact that we're still under 50 for those. But different story in Europe. He was talking about upside surprises there. We got that for most of the indicators in most of the European countries. The French went down by just a tick in terms of the composite, but manufacturing was over 50. Services were basically unchanged. Germany did drop a little bit on manufacturing, but services went over 50 in Germany. And the Eurozone, in terms of the overall Eurozone, the S&P Global consensus there, 48.8 from 47.8 for manufacturing, and the composite 50.2, while services are at 50.7. So definitely a floor underneath all of the bad news in pretty much every category from S&P today.
Mike McKee, thank you. I'm happy to say that Guy Johnson's alongside me to talk about some of this. Guy, that's the first sub-50, or rather sub-50, north of 50 read we've had on the Eurozone composite, going back to June.
Europe's got really lucky. Europe has got really lucky. Gas prices have come down really sharply. China has reopened. Everybody's getting hold of that narrative. The direction of travel here is really positive. In isolation, John, these are still fairly depressed numbers, but it's where we've come from. It's the direction of travel, and it's really positive.
The ECB emboldened to go 50, 50, 50?
Well, the third one maybe, but certainly the narrative over the last few days has been a fairly hawkish one. Yes, you've heard from people like Visco and Stunaras, but they feel like they're in the minority right now. Yes, you would have thought, judging by current market pricing, that at least two 50s are bolted on. The Bank of England looks like it's probably going to go 50 today's UK data, fairly depressed, but again, it's the direction of travel. And you take a look at some of the optimism indicators within this data, also fairly positive.
I've asked this question a few times this week. I'm sure you've done the same with your guests. Most people expect the ECB to hike more than the Federal Reserve this year. Are you hearing the same thing?
Yeah, but you've got to remember the ECB is playing catch-up.
Sure, to some degree, yeah.
So I think there is an element of kind of the timelines being a little bit sort of out of kilter. But
6 months behind.
It feels like the Fed's guiding us towards 25. It feels like the ECB is guiding us towards 50. Hence, you've gone from kind of a sub-1 euro to a, what are we, 109, and people talking about further upside to go.
I wondered whether the ECB could hike at all this cycle. Yeah. Never mind 50 basis points, 50 basis points, 50 basis points.
But we've come back, so a number of things have happened. You've been relatively lucky in terms of the economic data, so that has created the potential for more demand to come through. So the ECB is going to have to react to that. The ECB also is aware of the fact that in the Eurozone, just because of the regulated structure of labour, then potentially labour market data on the inflation front could be stickier. And they have, as Jean-Claude Trichet used to say, a single needle in their compass, and it is but one thing, and that's inflation.
Feels like the Bundesbank's back in charge over at the ECB. There is a fee for this guest appearance from Guy Johnson. The fee is a promo. Don't miss Guy Johnson's interview next hour with Chris Williamson, the chief business economist at S&P Global Market Intelligence. You happy with that?
Absolutely. He's the man that put the data together.
Looking forward to the programme, Guy. It begins in about 7 or 8 minutes' time. Let's get you some sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Yeah, well, we do have the S&P 500 right now down about 0.3%. Not surprisingly, most sectors are lower, led by materials. We also, I just want to mention, have an update on that NYSE trading situation. They're saying that all systems are normal. They're not saying what happened, but it does sound as though they're admitting that there was an issue of some sort. But at this point, again, all systems are operational and normal. And then, John, I have a board for you that I have a feeling you are going to really like, because I know you like a board that shows a simple story. So if we take a look at what's happening year to date, it's extraordinary, this rally that you've been talking about with all of your guests this morning. The NASDAQ 100 up 8.5%, China Tech up 19%, but then take a look at some of last year's better sectors, the defensive sectors, healthcare and staples, they are down. So this is the story. Growth is in, value out right now.
Abby, thank you. Stocks down 0.25%. Your trading diary up next.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
25 minutes into the session here, equities on the S&P trying to recover. We're down about 0.2%. The Nasdaq slightly positive, up 0.1%. Over the next week, 25% of the S&P 500 reporting earnings. It really kicks off big time with Microsoft after the close. In the trading diary, not just that, President Biden meeting with top Democrats at 3 p.m. Eastern Time. Microsoft, as I say, after the closing bell a little bit later. Results from Tesla, IBM coming up on Wednesday. US fourth quarter GDP and another round of jobless claims coming up on Thursday. And finally, PCE numbers and the UMich sentiment survey to round out the week on Friday. Live from London. That does it for me. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmer's fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem.
hundreds of people started arriving at their bottling plants with their lucky bottle caps, they realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund.